Very good day, friends. In this video, we are going to pick up the topic on salaries and we'll see how to compute income under the head salaries. We will look at various aspects, areas or themes, and this is the theme index. As you can see on your screen, the timestamp for this is given in the description box. We'll first discuss some important basic concepts. As far as the relationship of the payer and the recipient is concerned, employer-employee relationship is necessary for income to be taxed under the head salaries, right? And the key test is to see whether the employer exercises control and supervision over the employee. If this test fails, then income cannot be taxed under the head salaries. It may be taxable under the head PGBP or IFOS in that case, but not under the head salaries. The scope of taxation is something we have referred in the video on residential status and scope of total income. Just to quickly recap, if salary income is in the nature of Indian income, then it is taxable in the hands of all the person irrespective of their residential status. Indian income, income which is received in India or is deemed to be received in India or which accrues or arises in India or is deemed to accrue or arise in India, right? If the salary income is in the nature of foreign income, even then salary income is taxable in the hands of a resident and ordinarily resident ROR on global taxation basis, but not in the hands of a RNOR or a non-resident. When is salary income deemed to accrue or arise in India? We have already seen that where services are rendered in India, then salary income is deemed to accrue or arise in India under section 9. But where services are rendered outside India, there is only one case where salary is deemed to accrue or arise in India, else it is not deemed to accrue or arise in India. What is that one case? Where salary is payable by the government to a citizen of India, right? But even in that case, the allowances or perquisites which are paid or allowed outside India are exempt in India by virtue of section 10(7). What about salary received by a partner of the firm from such firm? In that case, any salary, bonus, commission or remuneration which is received by a partner from the firm is not taxable under the head salaries. Why? Because employer-employee relationship is absent. This is specifically covered under the head PGBP and we will discuss this in the video on PGBP. What about salary or remuneration received by MP, MLA and MLC? The concept is similar. Since employer-employee relationship is absent, such remuneration is taxable under the head IFOS and not under the head salaries. But in such case, there is an exemption provided under section 1017, which we have discussed in the video on exempt incomes, that daily allowance or constituency allowance is exempt in their hands. Now we will come to the basis of charge. The basis of charge. And this is provided by section 15. So section 15 provides for the basis of charge for income taxable under the head salaries. And what does it say? It says that the following income is taxable under this head. And there are three bases. One is on due basis. Salary which is due in the previous year. Salary which is due in the previous year, it is taxable in that previous year whether it is paid or not. So salary is due in the previous year 2022-23 and it is paid in the year 23-24. It doesn't matter. It will be taxable on due basis in previous year 22-23. So whether it is paid or not, it becomes taxable in the previous year in which it is due. Then salary which is paid or allowed in the previous year, though not due or before it became due. That means it is due in the previous year 2023-24, for example. That is in the next previous year, but it is being paid as advance. So salary is being paid or allowed in the previous year 22-23, though it becomes due in the next previous year. In that case also, since it is salary in advance, it will be taxable in the previous year 22-23 in which it is paid or allowed. What about arrears of salary? So arrears of salary paid or allowed in the previous year is taxed in that previous year in which it is paid or allowed, if it is not charged to tax for any earlier previous year, right? There may be a situation where salary becomes due in previous year 22-23, but it is paid or allowed in previous year 23-24, that is the next previous year. So it becomes arrears of salary. but it will not be taxable in the previous year 23-24 because it will be taxable in previous year 2022-23 on due basis. But there may be a situation, for example, where salary is increased from an earlier previous year with retrospective effect. In that case, for the earlier previous years, the salary would not have been charged to tax because the increase is retrospective. And in that case, the arrears of salary will be taxable in the year in which the arrears are paid or allowed, because in that case it cannot be said that the salary was charged to tax in the earlier previous year. So what is the effect of this? The effect is that salary is taxable on due or receipt basis, whichever is earlier. But in the case of arrears of salary, the arrears are taxable on receipt basis, provided that they were not taxed earlier. If they were taxed earlier, then the salary would have been taxed on due basis in the year in which it became due, so it won't be taxed again in the year in which the arrears of that salary are paid or allowed. So, the concept of double taxation. That means one salary is taxed as above, it is not supposed to be taxed again. Double taxation is to be avoided. So one salary is taxed on either due basis or as advance or as arrears, it cannot be taxed again. We have already noted in the video on basic concepts that the method of accounting followed by the SSE is not relevant in computing salary income. What is important are the provisions for computing salary income as provided under section 15, 16 and 17, which we will discuss in this video. So whether the SSE follows cash system of accounting or mercantile system of accounting, it is immaterial for the purpose of computing income under the head salaries. Now let's quickly look at the master chart for computation of income under the head salaries. This master chart gives a very high level snapshot of the mechanism of computing the taxable income under this head. So in nutshell, what we need to do is to figure out the amount of taxable salary payments, taxable allowances, taxable perquisites, and then add all of them up. This will give us the amount of gross salary income. Now we need to provide deductions provided under section 16 from the gross salary income to arrive at the income taxable under the head salaries. And there are three deductions provided under section 16 on account of standard deduction, entertainment allowance, and professional tax. So we need to aggregate payments, allowances, and perquisites which are taxable, and from that we need to provide deduction under section 16, and that gives us the amount of income taxable under the head salaries. What is an allowance? An allowance is generally provided by an employer to employee to meet a particular expense. For example, house rent allowance to meet expenditure on payment of rent, overtime allowance for working overtime, transport allowance to meet transport expenditure, etc. On the other hand, what is a perquisite? It is a benefit or amenity which is provided by an employer to employee. It can be provided either directly or indirectly, or in cash or even in kind, and it is in addition to salary or wages. For example, employer may provide a residential accommodation, motor car, etc., and these are referred to as perquisites. So perquisites which are provided by an employer to the employee are taxable in terms of the provisions of the Act. However, certain perquisites are taxable not only when provided directly to the employee, but also to any member of his household. Even if the perquisites are provided to any member of the household of the employee, they are taxable in the hands of the employee. What are those perquisites? They are specified perquisites which we will look in due course in this video. What is the meaning of member of household? Member of household includes whom? It includes the spouse of the employee, children of the employee and their spouses, parents of the employee, servants of the employee, and dependents of the employee. Right? So we will look at those cases as well in this video where the perquisite is not only taxable when provided to the employee, but also taxable in the hands of the employee when it is provided to any member of the household of the employee. Now we look at some of the general payments which are fully taxable. Some examples are basic salary or wages, the overtime salary, fees, bonus, salary in lieu of notice period, or commission. These are fully taxable. Now, commission can be either based on fixed percentage of turnover. That means it could be, say, 1% of the turnover achieved by the employee, or it could be a fixed amount. So it could be paid to an employee at the rate of, say, 5,000 per month. What we need to note is wherever in the question it is stated that the commission is based on a fixed percentage of turnover, not a fixed amount per month, but based on a fixed percentage of turnover, then we need to consider that as part of salary for computing retirement benefits. We will look at this when we encounter such instances shortly in this video. Then we will understand how to use this particular concept. What we need to note as of now is that if the commission is based on a fixed percentage of turnover, not a fixed amount per month, then it is considered as part of salary for computing retirement benefits. And this is by virtue of a Supreme Court decision. Such commission is also referred to as CTO in this book. So wherever you find that expression CTO, it basically refers to commission based on fixed percentage of turnover. Now we move to the next theme, which is payments which are dearness and compensatory in nature. So these are basically payments which are provided by the employer to the employee to meet or to compensate for the enhanced cost of living. So these are in the nature of dearness and compensatory. So we will first look at certain allowances which are fully taxable, which are in the nature of dearness and compensatory. So these allowances are fully taxable. DA is fully taxable, city compensatory allowance, project allowance, overtime allowance, interim allowance, etc. are fully taxable. Now, as far as DA is concerned, DA could be of two types. DNS allowance could be of two types, and you need to carefully look at the language of the question. The question can state that as per the terms of employment, DA is to be considered as part of salary for computing retirement benefits. The question may state that DA is to be considered as part of salary for computing retirement benefits. If that be the case, then we need to make calculations accordingly. Now, this particular aspect can also be stated in certain other ways as well in the question. The question may, for example, state that the DA forms part of pay, or DA is part of salary as per terms of employment, or DA is part of salary as per terms. It means one and the same thing, that DA is to be considered as part of salary for computing retirement benefits, right? Or the question may directly state that DA is not supposed to be considered as part of salary for computing retirement benefits, in which case the calculation should be done accordingly. If the question is silent, if the question doesn't state anything and merely says that this is the amount of DNS allowance, then you can assume that DA does not form part of salary for computing retirement benefits, and to be on the safe side, you can mention this specifically in your answer by way of a note and then proceed to make the calculations. Now we will look at certain special allowances which have been prescribed under Rule 2BB, and these are exempt under Section 1014. And these special allowances are granted to meet either personal expenses at the place of duty or to compensate for the increased cost of living. And there are two such allowances. The first one is the underground allowance. It is provided to an employee working in uncongenial, unnatural climate in underground mines, and the allowance is exempt across the whole of India to the extent of 800 per month, and the balance is taxable. The second is a special compensatory allowance, which could be in the nature of tribal area allowance, scheduled areas, agency areas allowance, and exemption is available to all the employees. However, the allowance should be granted in specified states only. So the allowance is exempt in respect of specified states only, and the states that have been specified are Madhya Pradesh, Tamil Nadu, Uttar Pradesh, Karnataka, Tripura, Assam, West Bengal, Bihar, and Odisha. If such allowance is received by an employee in the specified state, then it is exempt up to 200 per month and the balance is taxable. Now what we note here is that the allowance is exempt up to 800 per month or 200 per month regardless of the amount of expenditure. We will now look at retirement benefits. As far as annuity is concerned, which means a fixed periodical payment, it is fully taxable. Gratuity. Gratuity is exempt to the extent provided under section 1010, right? And let's look at the chart. So gratuity may either be received while in service or it may be received on death, retirement, etc. If gratuity is received while in service, that means during the course of employment, then it is fully taxable, it is not exempt. Where gratuity is received on death or retirement, etc. of the employee, then it depends on the type of employee. If the employee is the employee of the central government, the state government or a local authority, then the gratuity received is fully exempt. The gratuity received is fully exempt. For other employees, the gratuity is exempt under section 1010 to the extent provided. And this depends on whether the employee is covered under POGA or not covered under POGA. POGA is what? POGA is Payment of Gratuity Act 1972. So where the employee is covered under POGA, the exemption is computed differently from an employee who is not covered under POGA. So first we will look at exemption for an employee who is covered under POGA. Exemption is lower of A, B or C. A is amount actually received as gratuity. B is the maximum exemption of rupees 20 lakhs, so this is the limit. And C is 15 days salary for each year of service. So we need to compute 15 days of salary and then we need to compute each year of service, and consequently we need to compute 15 days salary for each year of service, and exemption is lower of A, B or C. How do we compute 15 days salary for each year of service? This is equal to 15 days salary into years of service. This is equal to 15 days salary into years of service. So first we need to compute 15 days salary, right? So a month is of 30 days, 28 days, 29 days, 31 days, various number of days are possible. But how is 15 days salary computed? We divide 15 divided by 26. So salary into 15 divided by 26 is 15 days salary. Why 26? We are excluding Sunday, right? And on an average considering a month of 30 days, so which leaves us with 26 days. So 15 days salary is computed as salary into 15 divided by 26. What is the meaning of salary for this purpose? Salary is basic salary plus DNS allowance. Basic salary plus DNS allowance plus DA, which is last drawn, right? Before retirement, death, etc. This basic plus DA, which is last drawn, is the amount of salary. How do we compute years of service? So we figure out retirement date minus joining date. Retirement date minus joining date, and then we determine the period. And if the period is greater than 6 months, it is taken as 1 year. So if the period is say 10 years and 4 months, it is taken as 10 years. If the period is say 10 years and 9 months, it is taken as 11 years. So we figure out the years of service accordingly. Then we determine the amount of salary. Then we compute 15 days salary by multiplying salary by 15 divided by 26. And this gives us 15 days salary for each year of service. For each year of service, this is C. A is the amount actually received as gratuity and B is the maximum exemption of rupees 20 lakh. And thus we arrive at the exemption under section 1010. The balance becomes taxable. For employee who is not covered under POGA, exemption is what? Exemption is lower of A, B or C. A is the same as this, which is amount actually received as gratuity. B again is the same as this, which is the maximum exemption allowed of rupees 20 lakh. And C is what? There is a difference. Here it was 15 days salary for each year of service, and here it is half month salary for each year of service, right? So instead of 15 days salary, we take half month salary. So half month salary for each year of service. And how do we compute this? This is half month salary into years of service. Now, how do we compute half month salary? So we are breaking this down. How do we compute half month salary? Here 15-day salary was computed as 15 divided by 26. But here half month salary is divided by 2. But what? Here it was salary last drawn, but here it is average salary of 10 months preceding the month of event. So month of retirement or death, okay. So first we compute the salary for 10 months preceding the month of event. Preceding the month of event. So if say the retirement is on 1st of November, then from January to October is the period of 10 months preceding the month of event. So we compute the aggregate salary of that period. We figure out the average. That means that aggregate divided by 10, that means the average, and then we divide it by 2. That gives us half month salary. Right? Now what is salary for this purpose? In the case of covered under POGA, salary as we noted was basic plus DA, but here it is basic plus DA if terms of employment so provide. That means DA forming part of salary for computing retirement benefits, as we noted some time back. DA forming terms of employment plus commission is also included, provided it is based on fixed percentage of turnover. So salary means basic plus DA as per terms of employment plus commission based on fixed percentage of turnover. This is salary. So we compute salary, then we compute the salary for 10 months preceding the month of event. We determine the average of that, then we divide that by 2. That gives us the half month salary. Now we need to multiply it by what? We need to multiply it by years of service. Years of service is what? Retirement date minus joining date. Same as this. Same as this. Retirement date minus joining date. But the difference is, in the case of covered under POGA case, the period greater than 6 months is supposed to be taken as 1 year. However, in this case, only completed years are supposed to be taken. So if the period is say 10 years and 9 months, it will be taken as 11 years in this case. However, it will be taken as 10 years in this case because only completed years are supposed to be taken. So accordingly, we determine the exemption and the balance becomes taxable. Okay. Now, we will note from the manner of computing exemption in the POGA case and non-POGA case that there are key differences. And what are the differences? 4 main differences are: 1, in a POGA case, 15-day salary is taken. And how do we compute it? We compute it as 15 divided by 26. For a non-POGA case, instead of 15-day salary, half month salary is taken. So we compute the average salary for 10 months and then we divide it by 2. That comes to half month salary. Second difference, in the POGA case, salary which is last drawn is taken. Salary which is last drawn is taken. But in a non-POGA case, as we noted above, the average salary for 10 months preceding, the average salary of 10 preceding months is taken. So we determine the aggregate salary of the preceding 10 months, then we determine the average of that. And then we divide it by 2 to get half month salary. Third difference is the meaning of salary for this purpose. For a POGA case, salary includes full DA, whether or not forming part of salary for computing retirement benefits, but it doesn't include the amount of commission. So salary includes full DA but excludes commission. In a non-POGA case, however, salary includes DA as well as the commission, but DA forming part of salary for retirement benefits and commission based on a fixed percentage of turnover. So if the DA is not forming part of salary for retirement benefits, it is not included. If the commission is not based on fixed percentage of turnover, for example, if it is a fixed amount per month, it is also not included. So for a POGA case, salary includes full DA but excludes commission. For a non-POGA case, salary includes DA only if terms of employment so provide and commission only if it is based on fixed percentage of turnover. Finally, the fourth difference is on account of computing the duration in terms of years of service. So these are the key differences between a POGA case computation and a non-POGA case computation. Now, there could be a case where an employee has received gratuity from multiple employers during the course of the previous year. This could be a situation where the employee is simultaneously working with more than one employer. In that case, we need to note that the total exemption cannot exceed rupees 20 lakh, because rupees 20 lakh, as we noted above, is the maximum amount of exemption which can be granted under section 1010. So the total exemption cannot exceed rupees 20 lakh. There might be a situation where an employee may have received gratuity in an earlier previous year. In an earlier previous year, he retired and then he received gratuity and something was exempt under section 1010. And now in the current previous year, he is again retiring from another employer and he is receiving gratuity, for which he is now claiming exemption under section 1010 again. But what we need to note is that the maximum exemption for an SSE is rupees 20 lakh. So the overall cap is rupees 20 lakh and the exemption cannot exceed rupees 20 lakh. Therefore, the limit of rupees 20 lakh is reduced by the exemption claimed earlier. So if earlier the exemption claim was rupees 5 lakh, okay, the limit this time will not be rupees 20 lakh but will be 15 lakh only. And consequently, when we look at the formula above, exemption is equal to lower of A, B or C. So this B, which is rupees 20 lakh, will be considered as the reduced amount of rupees 15 lakh and the exemption will be computed accordingly. So this is how we compute exemption for gratuity. The next retirement benefit is pension. An exemption is provided under section 1010A. Exemption is provided under section 1010A in respect of pension. And what is the quantum of exemption? We will see in this chart. So pension can either be commuted or it can be uncommuted. Commuted pension means a lump sum pension, 5 lakh, 10 lakh, 15 lakh, 20 lakh. So there is a lump sum payment on account of pension. Uncommuted pension is not lump sum, it is periodical, say 2,000 per month, 10,000 per month, 20,000 per month. So as far as uncommuted or periodical pension is concerned, it is fully taxable. No exemption is provided. It is fully taxable. As far as commuted pension is concerned, exemption is provided under section 1010A. Exemption is provided under section 1010A. If the employee is the employee of central government, state government, local authority or a statutory corporation, the commuted pension is fully exempt. It is fully exempt. However, in the case of other employee, a partial exemption is provided. And this depends on whether the employee receives any gratuity or he does not receive any gratuity. Gratuity is what we discussed just now. So the exemption depends on whether the employee receives any gratuity or does not receive any gratuity. Where the employee receives any gratuity, then exemption is equal to commuted value of 1/3 of pension, which he is normally entitled to receive. So we figure out the pension which he is normally entitled to receive, and then we determine the commuted value of 1/3 of that pension, and that is the amount of exemption. In other words, this is the formula in simple terms. So 1/3 into commuted pension received divided by commutation percentage into 100. This is the formula. So the idea is first we figure out the pension which he is normally entitled to receive. Okay, and then we say that, for example, say 1 lakh is the pension which he is receiving, commuted at the rate of 50%. So 50%, so what is the pension which he is normally entitled to receive? We say 1 lakh divided by 50 into 100. So this is rupees 2 lakh. So 2 lakh is the pension which he is normally entitled to receive, because 1 lakh is the commuted pension which he is received as commutation of 50%. So therefore 2 lakh is the pension which he is normally entitled to receive, and then we figure out 1/3 of this 2 lakh. This is the amount of exemption. 1/3 of 2 lakh becomes the amount of exemption. So the simple formula is 1/3 into commuted pension received divided by commutation percentage into 100. If the employee does not receive any gratuity, then the exemption is basically half. Here it was 1/3 and here it is half. The other things remain the same. So commuted value of half of pension which he is normally entitled to receive is the exemption. So the formula becomes half into commuted pension received divided by commutation percentage into 100. So everything remains the same. Instead of 1/3, we have half. So in our case, if 50% pension has been commuted and he has received 1 lakh as commuted pension, then the pension which he is normally entitled to receive will be 2 lakh rupees and half of that will be 1 lakh rupees. So 1 lakh will be the exemption in this case. So half where the employee does not receive any gratuity and 1/3 where the employee receives any gratuity. This is the ratio which we need to keep in mind. The next retirement benefit is on account of leave salary or leave encashment. An exemption is provided in respect thereof under section 1010AA. Now employee is generally entitled to a certain fixed period of a fixed number of days of leave per year during the course of his employment. Leaves can either be availed, so the employee takes a leave, he takes a holiday, there is no tax implication, or leaves can accumulate. Now accumulated leaves in turn can either lapse, in which case also there is no tax implication. The terms of employment may provide that there is a certain date by which either you need to take the leave or you need to encash it. If you don't do anything, then the leave lapses. Or the accumulated leaves can be encashed during employment, or they can be encashed on retirement. So the leaves can be encashed either during employment or they can be encashed on retirement. Tax implications arise when the leaves are encashed. So when leave salary is received during employment, it is fully taxable. During employment, it is fully taxable. However, when leave salary is received on retirement, then exemption is provided. What is the amount of exemption? If the employee is the employee of central government or state government, the leave salary is fully exempt. It is not taxable. But in case of other employees, exemption is provided, which is lower of A, B, C or D. Which is lower of A, B, C or D. A is the amount of leave salary received. B is the maximum amount which can be exempt, which is rupees 3 lakh. C is 10 months into average salary. It's 10 months average salary, right? So we figure out the average salary and then we multiply it by 10 months. And D is the leave credit in terms of months into average salary. So the value of leave credit in terms of the salary, the value of leave credit in terms of salary. So A is leave salary received, B is rupees 3 lakh and C is 10 months into average salary. The question is, what is the meaning of average salary? So average salary is the average salary of 10 months immediately preceding the date of retirement. So whatever is the date of retirement, we determine the period of 10 months immediately preceding that date and figure out the total amount of salary for that. And then we determine the average salary and we multiply it by 10 months. So this is basically the amount of salary for the period of 10 months immediately preceding the date of retirement. And what is the meaning of salary for this purpose? Here the salary is basic salary plus Dearness allowance if terms of employment so provide for, which means DA forms part of salary for computing retirement benefits, and commission based on a fixed percentage of turnover. So a fixed commission is not included, and DA, which doesn't form part of salary for computing retirement benefits, is also not included. So this is the meaning of salary. So we figure out what is the amount of salary, and then we figure out the salary for the 10 months duration immediately preceding the date of retirement. This is the amount in C. In D, we first compute the leave credit in terms of months and then we multiply it by average salary. So in effect, we determine the value of the leave credit in terms of salary. Leave credit is what? Leave credit is the amount of leaves which are standing to the credit of the employee. So how do we figure this out? We first determine the leave entitlement. What are the total number of leaves for which the employee is entitled to during the period of his service? During the period of his service, the total amount of leaves to which he has been entitled to, minus leaves availed, lapsed or encashed, because these are the number of leaves which the employee has utilized. Either he has availed, or those leaves have lapsed, or he has encashed those leaves while in employment, which of course is fully taxable. So what is left is the leave credit, which is getting encashed upon retirement. Okay, and we divide this by 30 days. We divide this by 30 days to get the amount of leave credit in months. And there is a limit to this. The limit is a maximum of 30 days for each completed year, right? So while determining the leave credit, we take only completed years into account, and maximum of 30 days. So for example, an employee has served for 10 years and 10 months. For 10 years and 10 months, so we take only 10 year of leave entitlement into account. And if the leave entitlement for, say for example, 32 days of leave per year, we don't multiply 32 by 10. We take a maximum of 30 days only. This is the limit which has been set. So 300 days is the leave entitlement which we take for this particular purpose, and we reduce leave availed or lapsed or encashed, which gives us the balance of leave credit, and we divide it by 30 days and we get leave credit in months. This is something that we multiply by the average salary, which we compute for C as well. So lower of A, B, C or D is the amount of exemption. So this is how we compute exemption for leave salary. If leave salary is received from more than one employer in the same previous year, the maximum exemption cannot exceed rupees 3 lakh. Similarly, if leave salary was received in the earlier previous years also, an exemption on this account was claimed in those earlier previous years, then that amount of exemption claim will need to be reduced from the limit of 3 lakh, and this will ensure that the overall limit of exemption is rupees 3 lakh for an SSC, which is a lifetime limit. Okay. Now we will talk about the tax treatment in regards to provident funds. There are four kinds of provident funds which we will be talking about. First is Statutory Provident Fund or SPF. This is set up or governed by the Provident Fund Act PF Act of 1925, and it's basically meant for employees of the government. Second is a Recognized Provident Fund or RPF. It means a fund which is established under the EPF Act of 1952, Employees Provident Fund Act, or which is recognized under the Income Tax Act, basically Schedule 4, Part A of the Income Tax Act. So either it's established under EPF Act or it's recognized under the Income Tax Act. Third is the Unrecognized Provident Fund or UPF, which is basically a fund which is not a RPF. Then there is a Public Provident Fund PPF, which most of us are aware of. It's the general provident fund which is meant for every individual, whether in employment or not, and it's governed by the PPF Act of 1968. So employer does not contribute. Basically, any person can contribute to the PPF. Even though this has got nothing to do with income taxable under the head salaries, but we will still discuss the tax treatment in respect of PPF for the sake of completeness. Now, when we talk about the provident fund and the credit balance or accumulated balance in a provident fund account of an employee, then there are four components which form part of such balance. One is the employee's contribution, two is the employer's contribution, third is the interest on employee's contribution, and interest on employer's contribution. So the contribution of employee and the employer and interest thereon. So these are the four components, and we will now see the tax treatment of each of these four components across the various types of provident funds. We will look at the tax treatment for the phase or the period during employment. What is the tax treatment for various elements? And the tax treatment in respect of lump sum payment of accumulated balance, which is received by an employee on his retirement or resignation or termination. So during the course of employment and on retirement or resignation termination, what is the tax treatment of the amount that is received on account of the accumulated balance? So as far as SPF is concerned, Statutory Provident Fund, employer's contribution is exempt. Employer's contribution is exempt. Employee's contribution, there is no question of taxation under the head salaries because it's employee's own contribution and employer is not contributing anything in respect of this amount. But in respect of employee's contribution, the employee can claim deduction under section 80C from the gross total income, right? So employer's contribution is exempt while 80C can be claimed in respect of employee's own contribution. Now in respect of employer's contribution, what is the tax treatment for interest? Interest credited on employer's contribution is exempt. Interest credited on employer's contribution is exempt. And what about interest credited on employee's contribution? Interest credited on employee's contribution is also exempt. But there is a threshold. There is a threshold beyond which if the employee makes a contribution, then interest relating to that excess is not exempt. It becomes taxable, right? So interest credited on employee's contribution is exempt, but it is not exempt on excess contribution. If the employee contributes beyond a certain threshold, which is 2.5 lakh or 5 lakh per year, which we will talk about shortly, then interest related to that excess is not exempt, right? So as far as SPF is concerned, employer's contribution is exempt. Employee's contribution, in respect of that, 80C can be claimed. Interest on employer's contribution is exempt and interest on employee's contribution is also exempt, but it is not exempt in relation to excess contribution, excess beyond a certain specified threshold. As far as lump sum payment of accumulated balance is concerned, as far as lump sum payment of accumulated balance is concerned, it is exempt in the case of SPF. So this is the tax treatment of SPF. Now we come to RPF. Employer's contribution. What about employer's contribution? Employer's contribution is exempt up to 12% of salary. Beyond 12% of salary, it is taxable. What is the meaning of salary for this purpose? It means basic salary plus DA if it forms part of salary for computing retirement benefits, and commission if it is based on fixed percentage of turnover. This is salary up to 12% of salary we compute, and then employer's contribution up to this level is exempt. Beyond this, it becomes taxable. There is another layer of taxation. We need to see the combined contribution of employer to three funds: Recognized Provident Fund, RPF, Approved Superannuation Fund, ASF, and National Pension Scheme, NPS. If the combined contribution of employer during the year to all these three funds is greater than 7.5 lakh, then the excess beyond 7.5 lakh is also taxable. So as far as employer's contribution goes, employer's contribution which is above 12% of salary is taxable. Secondly, employer's contribution, which is the combined contribution to RPF, ASF and NPS, which is greater than 7.5 lakh, is also taxable. As far as employee's contribution is concerned, one can claim deduction under section 80C. Now, interest on employer's contribution. Interest on employer's contribution is exempt up to 9.5%, and beyond 9.5% it is taxable. Further, there is another layer of taxation. Interest related to the combined contribution of employer to RPF, ASF and NPS, which is greater than 7.5 lakh, is also taxable. So as we saw that if the employer makes a combined contribution to RPF, ASF and NPS, which is greater than 7.5 lakh, the contribution becomes taxable. And the interest relating to such excess also becomes taxable. What about interest credited on employee's contribution? it is exempt up to 9.5%, and beyond 9.5% becomes taxable. And there is another layer of taxation. That means interest which relates to excess contribution of employee. If the employee contributes in the year beyond a certain threshold, which is of 2.5 or 5 lakh, which we will talk about shortly, then interest relating to that excess is not exempt, it is also taxable. So as far as RPF is concerned, to recapitulate, employer's contribution is exempt up to 12% of salary. Beyond that, it is taxable. Salary means basic plus DA if it forms part of salary for purposes of computing retirement benefits, and commission based on fixed percentage of turnover. Secondly, if the employer makes a combined contribution to RPF, ASF and NPS greater than 7.5 lakh, that excess is also taxable. Employee's contribution, ATC, can be claimed. Interest on employer's contribution is exempt up to 9.5%. But interest relating to this combined contribution, which is more than 7.5 lakh, is also taxable. Interest credited on employee's contribution, just like interest credited on employee's contribution, the limit of interest is the same at 9.5%. Beyond 9.5% interest, it becomes taxable. Secondly, the interest relating to the contribution made by an employee which is in excess of the prescribed limit of 2.5 lakh or 5 lakh. So if the employee makes an excess contribution, interest relating to that excess contribution is also taxable. What is the tax treatment for lump sum payment of accumulated balance? It is exempt if certain conditions are satisfied. If those conditions are not satisfied, then lump sum payment of accumulated balance is not exempt, it is taxable. Now, what are those conditions? Let's see. Conditions for exemption of accumulated balance of RPF. The accumulated balance of RPF is exempt if any of the conditions in A, B, C or D, which you can see on the screen, are satisfied. A, if the employer has rendered continuous service for at least 5 years. Say an employee renders service for 6 years and then he retires and he receives accumulated balance, it is exempt. If that is not the case, for example, if the employee renders continuous service only for 3 years and then retires, then what happens? Then accumulated balance is still exempt if the service has been terminated due to the ill health or contraction or discontinuance of employee's business or other cause which is beyond the control of employee. If the cause is beyond the control of employee and the amount is received, then that amount in terms of accumulated balance is exempt, right? If this is still not the case, even then the amount is exempt if the balance, if the accumulated balance in the RPF is transferred to the RPF account with the new employer. Say the employee resigns before the completion of 5 years and the condition of B is also not fulfilled, but without break he transfers his balance of RPF to the RPF account with the new employer. In that case, since there is continuation, since there is no break, exemption is available. Exemption is available. Now subsequently, in the case when the employee receives the accumulated balance upon retirement, resignation, etc. From the employment of the new employer, then both the periods, that means the period of service rendered with the old employer plus the new employer, will be aggregated to check whether this condition of 5 years is met or not. So service period under the previous and new employer will be aggregated to check the 5-year condition. There is another situation in which exemption is available. If the entire balance in his RPF account is transferred to the NPS account, which is referred in section 80 CCD, for which a deduction is allowed, which we will talk about when we talk about deductions from gross total income. So if the entire balance in RPF is transferred to the NPS account, then also the accumulated balance is not taxed, it is exempt, right? If these conditions A or B or C or D, neither of them are fulfilled, then the amount is not exempt, it is taxable. It is taxable. So going back to our table, this is the tax treatment for RPF. Now looking at the tax treatment for unrecognized provident fund or UPF, employer's contribution is exempt, interest credited on employer's contribution is exempt, employee's contribution, ATC deduction is not available. It is not available because it's unrecognized provident fund. Interest credited on employee's contribution is also exempt. So as you note, even though the provident fund is unrecognized, the contributions as well as interest thereon is exempt during the employment, while the contribution is made by the employer and while the interest accrues on that contribution. But there is no exemption available for lump sum payment of accumulated balance. It is not exempt and it becomes fully taxable. So how is lump sum payment of accumulated balance taxed? Employee's contribution is not taxed, it is exempt because ATC deduction was not allowed earlier. So therefore, it is not taxed again when it is received as part of the accumulated balance. As far as interest on employee's contribution is concerned, it is taxable, but not under the head salaries because the interest is not received on account of employee-employer relationship. It is the interest on employee's own contribution and therefore it is taxable under the head IFOS. Now what about employee's contribution and interest thereon? It is taxable under the head salaries, right? So as far as UPF goes, employer's contribution and interest thereon and interest on employee's contribution, so interest and contribution both are not taxable till they are received on account of lump sum payment of accumulated balance, in which case employee's contribution is not taxed, interest on employee's contribution is taxed under the head IFOS, and employer's contribution and interest thereon is taxable as salary, and ATC deduction is not available in respect of UPF for employee's own contribution. Lastly, PPF. Employer's contribution is not relevant because employer doesn't contribute and therefore interest credited on employer's contribution point is also not relevant. When the employee contributes, he can claim deduction under section 80C, interest on his contribution is exempt and lump sum payment of accumulated balance is also exempt. So everything is exempt in the case of PPF and further ATC can also be claimed. Okay. So we saw that as far as interest on employees' own contribution is concerned, it is exempt in the case of SPS and there is a limit of 9.5% for RPF, up to which it is exempt. Further, if there is excess contribution by the employee, then interest relating to that excess contribution is not exempt, it becomes taxable, and we will look at this provision now. Interest accrued during the previous year relating to excess employees' contribution to SPF and RPF is not exempt. So this doesn't apply to PPF or UPF. This provision applies to employees' contribution to SPF and RPF. So interest accrued during the previous year relating to employees' contribution exceeding the following limit is not exempt. And the limit applies from previous year 21-22. So there is no limit till previous year 2021. So whatever be the amount of employees' contribution to SPF or RPF till the previous year 2021, it remains exempt. It remains exempt so long as it is not exceeding the interest rate of 9.5% in case of RPF. For SPF, of course, there is no limit as far as rate of interest is concerned. So till previous year 2021, there is no limit which is applicable, and therefore interest relating to the employee's contribution, whatever be the amount of employee's contribution, remains exempt. But there is a limit in terms of employee contribution which has been put into effect from previous year 21-22, and the limit is either 2.5 lakh or 5 lakh per year. If both employee and employer are contributing to the fund, then the limit for employee's contribution is 2.5 lakh. If the employee contributes in the year beyond 2.5 lakh, then we pick up the excess and then we determine the interest relating to that excess, and that is not exempt. That is taxable. However, if the employer doesn't contribute, if only the employee is contributing to that fund, then this limit is doubled to 5 lakh per year. Taxable interest is computed as per Rule 9D, as per which separate accounts within the Provident Fund account are required to be maintained for non-taxable contribution and taxable contribution. So you need to be clear as to what is the interest that is taxable and what is the interest that is exempt. So interest is taxable only on the amount of employees' contribution which exceeds this specified limit and which is made on and from previous year 21-22. The rest of the employees' contribution interest thereon remains exempt. So you need to bifurcate the entire bucket of employees' contribution into two parts. Non-taxable contribution, that means contribution in respect of which the interest remains exempt. Taxable contribution, that means employees' contribution in respect of which the interest is not exempt. It is taxable. So two separate accounts need to be created. And what is the composition of these two accounts? Closing balance in the account as on 31st March 2021. 31st March 2021, closing balance, it represents what? It represents the employee's contribution made till previous year 2021. And we saw that interest in relation to this amount is not taxable, it remains exempt. That's why this entire closing balance forms part of non-taxable contribution account. This is not relevant to taxable contribution account, therefore. Then we add any contribution made by the person or the employee during the previous year 21-22 and subsequent previous years. So here we talked about the contribution till previous year 2021. In number 2, we are talking about contributions made by the person or the employee on and from previous year 21-22, and here we need to bifurcate. Contribution up to the threshold of 2.5 lakh or 5 lakh as the case may be, interest thereon will not be taxable, so it will be added to the non-taxable contribution account. The excess beyond 2.5 lakh or 5 lakh will form part of taxable contribution account. Third, we will add interest accrued on number 1 and number 2. Interest which is accrued on these contributions in number 1 and number 2. Why? Because interest will be earned on interest as well. So the interest which has accrued on which interest will be earned also needs to form part. So interest accrued on 1 and 2 will accordingly form part either of the non-taxable contribution account or taxable contribution account. Withdrawals, if any, from such account will need to be reduced, and finally we will have the balance for non-taxable contribution account and taxable contribution account. And accordingly, the interest which accrues in respect of the taxable contribution account will become taxable. It will not remain exempt. So what is the effect? In effect, only the interest relating to the employee's contribution exceeding the threshold of 2.5 or 5 lakh as the case may be, which is made on and from the previous year 21-22 is taxable. Interest relating to all other contribution remains exempt. Okay, so this is the effect of the provision. We now talk about approved superannuation fund or ASF. Tax treatment during employment and tax treatment on account of payment from the fund. During employment, as far as employer's contribution is concerned and interest on employer's contribution is concerned, the provisions are similar to what we saw in the case of RPF in relation to the point regarding the combined contribution. So we saw in the case of RPF that if the combined contribution made by the employer to all the three funds, RPF plus ASF plus NPF, is greater than 7.5 lakh in the year, then that excess is taxable. And the interest which relates to this excess is also taxable. So this is the treatment regarding employer's contribution and interest thereon as far as ASF is concerned. Employee's own contribution, the employee can claim deduction under section 80C. Interest on employee's contribution, it is exempt. Payment from the fund, The accumulated balance, it is exempt if the payment is made in certain circumstances, for example, in the case of death. So this is the tax treatment for ASF. Now, as far as National Pension Scheme is concerned, NPS, during employment and tax treatment for payment from NPS. Employer's contribution. So both employer and employee can contribute to the NPS scheme. When the employer contributes, you should first include the employer's contribution under the head salary. So it becomes taxable under the head salaries. Thereafter, the deduction can be claimed under section 80 CCD on account of not only the employer's contribution, but also the employee's contribution. So we will talk about this in detail in the video on deduction from gross total income. So as far as employee's contribution is concerned, it is included under the head salaries first. Thereafter, both for employers and employee contribution, deduction is available under section 80 CCD. We also need to keep in mind that as we noted for RPF and for ASF above, if the employer makes a combined contribution to RPF, ASF and NPS which is more than 7.5 lakh during the year, then that excess becomes taxable and the accretion related to that excess is also taxable. The accretion, though otherwise, is exempt under section 1044. This and the tax treatment on account of payment from NPS is something that we will discuss in the video on 80 CCD. So the point to note is you first include the employer's contribution under the head salaries and also the combined contribution to RPF, ASF and NPS greater than 7.5 lakh as well as accretion pertaining to that excess. Then when we are looking at 80 CCD, then we need to provide the deduction under that section on account of employers as well as employees' own contribution. We now look at the last point as far as Provident Fund is concerned. Tax treatment in respect of combined upper limit for employers, not employees, employers' contribution to RPF, ASF, NPS, which is greater than 7.5 lakh. And P denotes that this amount is a perquisite. So amount which is taxable as per these provisions, that means the excess amount which we will just now discuss is a perquisite. It is taxable as a perquisite. So what is basically taxable is on account of these two components. Number one, employer's contribution to RPF, ASF and NPS which is in excess of 7.5 lakh in a previous year. So what is taxable? The excess is taxable and it is taxable as perquisite. Secondly, as we saw, accretion on such excess is also taxable. And accretion could be, for example, interest, dividend, etc. So whatever is the accretion in relation to this excess, it is also taxable. It is also taxable as perquisite. And it is computed in the prescribed manner. This accretion, so excess beyond 7.5 lakh is taxable and the accretion in relation to the excess is taxable, which is calculated in the prescribed manner. So computation of taxable accretion has been prescribed by Rule 3B. Computation of taxable accretion has been prescribed by Rule 3B. The formula is not very complicated if you carefully understand and note, and if you practice a bit, then it's quite simple. It's not difficult at all. So basically there are three steps. Step 1, step 2 and step 3. Step 1, 2 and 3. In the first step, you need to compute certain amounts for the period from the previous year 2021 to the previous year preceding the current previous year. And in step 2, you need to compute certain amounts for the current previous year. So if we are talking about previous year 2022, 23, then step 1, amounts need to be computed for previous year 2020, previous year 2020, 21 and 2021, 22. Okay. And in step 2, the amounts need to be computed for previous year 2022 and 23. Okay. Now, what are the amounts? In step 1, what are the amounts for previous year 2021 and 21-22? The aggregate of taxable employers' contribution to the fund or scheme which is greater than 7.5 lakh for each previous year. So for each of the previous years, that means 2021 and 21-22 in our case, for each of these previous years, we need to see what was the amount of combined employers' contribution to RPF, ASF and NPS. And the excess of that aggregate over 7.5 lakh is something that we need to take, and that we call PC1. So excess of that aggregate. So if in previous year 2021, if say the contribution in each of these previous years is 10 lakh, then the excess is 2.5 lakh, 2.5 lakh in each of these years, and the aggregate of that is 5 lakh. So 5 lakh becomes PC1. This is an example, right? Then we need to find out the aggregate of what? Taxable accretion for each previous year computed under this rule, right? So when we found out PC1, then in each of these previous years, we need to apply rule 3b and figure out the amount of taxable accretion computed as per rule 3b for each of these previous years, and we need to aggregate that as well, and that becomes TP1. So aggregate of the excess beyond 7.5 lakh for each previous year, that becomes PC1, and we figure out taxable accretion computed as per rule 3b for each of those two previous years, and we combine, we aggregate that, and that becomes TP1. So these are the amounts we need to compute from the previous year 2021 to the immediately preceding previous year. Now we come to step 2, under which we need to compute the following amounts for the current previous year, And what are the amounts? 2.1. First, we need to compute the excess of the employer's combined contribution to these three funds, which is in excess of 7.5 lakh, and we call that PC. So for the earlier years, we called that PC1, and for current year, we are calling it PC. Then we need to figure out the income which has accrued in the fund or the scheme during the year, and we call that as I. Okay? Income accrued in the fund or scheme during the year, we call it I. Then we compute the average balance, which is the opening balance in the fund or scheme as on 1st April and closing balance as on 31st March divided by 2. That gives us FAVG. Then we compute the rate of return. The rate of return is I divided by FAVG. That means the income which has accrued, I, income divided by the average balance, it gives us the rate of return. Now we come to step 3, which is the important step, under which we need to find out the amount of taxable accretion under rule 3b. Now we need to compute a certain amount, and we need to apply the rate of return to that amount. We need to compute a certain amount and then apply the rate of return, or multiply that amount by the rate of return, by R. And what is that amount? That amount is PC divided by 2. PC, that amount is PC divided by 2. So taxable accretion in the current year beyond 7.5 lakh, the excess, that is PC. So PC divided by 2, we half that, and to that we add PC1 plus TP1. So PC1 plus TP1. So we find out the half of PC, and then we find out PC1 and TP1, and we add these, right? And to the aggregate of these, we apply the rate of return, which is R. When we apply this rate of return, we get the amount of taxable accretion, which is taxable as perquisite under rule 3b. So this is about Provident Fund, and on the face of it, it may look slightly complicated, but trust me, it's not complicated. If you go through this video again and again, if you have any doubts, you can ask me, and especially this particular chart gives you a very nice snapshot, and this is something that you need to keep in mind and remember fully. Okay, the tax treatments of different types of items, different types of items, A1, A2, A3, A4, and B across these 4 types of Provident Fund, right? And then you need to keep in mind these various limits of 12% combined contribution greater than 7.5 lakh, 9.5%, 9.5%, and so on. And you need to keep in mind these various rules. And further, the conditions that we discussed for exemption of accumulated balance in the case of RPF, A, B, C, or D. And then you need to basically keep in mind the limits of 2.5 lakh or 5 lakh, which is for the employee's own contribution, right? Which if it exceeds these particular limits from the previous year 21-22, then the interest related to this excess is not exempt. It becomes taxable. And then for ASF, we need to keep these rules in mind, which we discussed. Basically, the point regarding employees' combined contribution to these 3 funds greater than 7.5 lakh, and similar for NPS. And finally, what we discussed about the contribution greater than 7.5 lakh on account of employers' contribution to these 3 funds, which is taxable as perquisite. So the excess beyond 7.5 lakh is taxable, and accretion relating to such excess is taxable, which is computed as per Rule 3B. And the mechanism of computation as per Rule 3B is something that we discussed in this particular table. The next component under the theme of retirement benefits is VRS compensation. VRS compensation. And exemption is available under section 1010C, read with Rule 2BA. Exemption is available in respect of what? In respect of any amount which is received or receivable on voluntary retirement or termination. And Rule 2BA lists down various conditions which the voluntary retirement or separation scheme should fulfill, but those conditions or Rule 2BA is not relevant for exam, so we will not discuss that. What we need to keep in mind is that in respect of VRS compensation, that means amount received or receivable on voluntary retirement or termination, exemption is available under section 1010C. And what is the quantum of exemption? It is the lower of A, B, C, or D. A is the amount received, B is the maximum exemption of rupees 5 lakh which can be availed, C is 3 months salary, 3 months salary, and we multiply that by completed years of service, not part year but completed years of service, right? And in D, we multiplied the salary at the time of retirement. That means the salary at the time of retirement, and we multiplied that by months of service which is left, right? So as far as completed years of service is concerned, we multiply that by 3 months salary, and as far as the months of service that are left, we multiply that by salary at the time of retirement. And what is salary for this purpose? It is basic salary plus DA, which forms part of salary for computing retirement benefits, and commission if it is based on fixed percentage of turnover. The point to note is that this exemption under 1010C is available only one time during the life of an SSC. So an SSC can avail this only once, not more than once. Now we come to retrenchment compensation. Okay. A workman may receive compensation at the time of his retrenchment, and the compensation may be received under the Industrial Disputes Act 1947 or under any other act, rule, order, or notification. So if compensation is received by a workman at the time of his retrenchment, then section 1010B grants exemption, which is computed as lower of A, B, or C. A is the amount received, B is the maximum possible exemption of 5 lakh, and C is the amount calculated under the Industrial Disputes Act. How is that amount calculated? It's basically 15 divided by 26, which basically reflects half of a month, right? 15 divided by 26, and we multiply this by what? Average pay of last 3 months. So we figure out the pay of last 3 months and compute the average of that, multiplied by completed years of service. And while figuring out the completed years of service, any period in excess of 6 months is taken as a year. Okay, so we figure out the average pay of last 3 months, then we figure out the completed years of service, and we multiply both of these and further by 15 divided by 26. That gives us the amount of C, and the exemption is lower of A, B or C. So this brings us to the end of the theme pertaining to retirement benefits, and now we move to our next theme, which is tax treatment in respect of components pertaining to health and life. So as far as fixed medical allowance is concerned, it is fully taxable. For example, if fixed medical allowance per month is given by the employer to the employee, it is fully taxable, it is not exempt. As far as medical facilities are concerned, right, and they may be in the form of payment or reimbursement of medical expenditure or value of medical treatment, right, and if these medical facilities are provided by the employer to the employee, these are considered as perquisite. And the tax treatment of such perquisite in the nature of medical facility is something that you can now see on your screen. So the medical treatment can be in India and outside India. The tax treatment depends on whether the medical treatment is in India or whether it is outside India. If the medical treatment is in India, then the perquisite is exempt. The perquisite on account of such medical treatment is exempt in 4 cases. In 4 cases. Number 1, the value of medical treatment in any hospital maintained by the employer. So if the medical treatment is carried on in the employer's own hospital, then no perquisite arises, then no taxable perquisite arises, it is exempt. Number 2, if expenditure is incurred by the employee on medical treatment in a government hospital or a local authority hospital or any other hospital which is approved by the government for medical treatment of its employees, right, and the employer reimburses that expenditure to the employee, then the perquisite arising on account of that is also exempt. Number 3, if the employee has incurred expenditure on medical treatment but in respect of a prescribed disease or ailment in a hospital which has been approved by the tax authority, the reimbursement of that expenditure is a perquisite which is not taxable, it is exempt. And lastly, if the employee has incurred expenditure on medical treatment in respect of any illness relating to COVID-19, then the reimbursement of such expenditure by the employer is also exempt. It is not a taxable perquisite. But the condition is that the employee is required to submit certain prescribed documents to the employer. The employee is required to submit certain prescribed documents. And there is this notification which says that prescribed documents include all necessary documents of medical diagnosis or treatment of the employee or his family member for COVID-19 or illness related to COVID-19, and there is a timeline, right? Suffered within 6 months from the date of being determined as COVID-19 positive. So the date when the employee or the relevant person, that is family member, is determined as COVID-19 positive, there is a timeline of 6 months, and within that timeline the medical treatment is there and there is this reimbursement of expenditure, and such reimbursement of expenditure is not a taxable perquisite. So if the medical treatment is in India, then in these 4 cases taxable perquisite does not arise. Now what happens if the medical treatment is outside India? If the medical treatment is outside India, then expenditure incurred by the employer needs to be bifurcated on medical treatment, on stay abroad and on travel abroad. As far as medical treatment and stay abroad is concerned, it is exempt to the extent permitted by RBI. So the question will state the extent to which the expenditure has been permitted by the RBI on medical treatment and stay. Expenditure beyond that limit will be taxable as perquisite. Up to that limit will remain exempt. So this goes as far as medical treatment and stay is concerned. But different consideration apply when we talk about travel expenditure. As far as travel expenditure is concerned, it is exempt. it is fully exempt. But there is a condition. It is exempt only if the gross total income of the employee, not income under the head salaries, but the gross total income of the employee is up to rupees 2 lakh. So it's a very small amount, so it's mostly practically irrelevant. So travel expenditure is mostly not exempt, it is taxable because the gross total income basically exceeds this limit in most of the cases. So travel expenditure abroad is exempt only if the gross total income of the employee is up to rupees 2 lakh, it doesn't exceed rupees 2 lakh. And how is this limit computed? This gross total income limit is computed before including such travel expenditure. So if you include the travel expenditure, the income on account of that perquisite will increase. So gross total income will increase, but the limit of 2 lakh is supposed to be calculated without considering such travel expenditure, right? And it is exempt only if the gross total income is up to rupees 2 lakh. Now, health insurance premium remains exempt. So if the employer pays health insurance premium for the employees, it is not taxable, it is exempt. Now, what we need to note is that the aforesaid benefits are covered not only in respect of the employee, but also for any member of his family. So treatment in India, treatment outside India, the exemption in respect of perquisite is available not only in respect of the employee, but also for any member of his family. And what is the meaning of family for this purpose? The meaning of family is spouse of the employee, children of the employee, whether dependent, whether not dependent, it doesn't matter, spouse and children. But parents, brothers and sisters should be wholly or mainly dependent on the employee. If parents, brothers and sisters are not dependent on the employee, then they are not part of the family, they are not considered as member of the family. So the coverage of these benefits is for the employee as well as for any member of his family. When we talk about hospital, as we discussed above, it includes a dispensary, it includes a clinic, as well as a nursing home, right? We saw the tax treatment of expenditure incurred by the employer on medical treatment outside India, right? And when we talk about stay expenses and travel expenses, attendant may also be accompanying the person for whom the medical treatment is being undergone. So what happens to that expenditure? So expenditure incurred by the employer on stay and travel of one attendant. So the limit is one attendant who accompanies the patient in connection with the treatment is also covered by the exemption. So that is also exempt. So when we talk about stay expenses, to the extent it's permitted by RBI, and when we talk about travel expenses, it's exempt only if the GTI is up to rupees 2 lakh. And this particular exemption is available in respect of expenditure not only of the person who is being treated, but also up to one attendant only. What about personal accident policy? The employer may pay personal accident premium or premium on account of personal accident policy for the employee. So this is also exempt when the employer takes a personal accident policy on the life of employees and pays premium. It is not taxable as a perquisite. Now we saw above that when the treatment is in India on account of COVID-19 or related illnesses, then reimbursement of expenditure which is made by the employer to the employee is not taxable as perquisite, right? What we need to note is the amount which is covered under the head salaries and is exempt is basically the amount that is reimbursed by the employer. If the reimbursement is by a person not being an employer, by a friend or by a colleague or by any other person, then the tax treatment is done under the head IFOS and it is covered under section 56 2X, and it is exempt depending on certain conditions which we will talk about in the video on IFOS. The medical facility or benefit which is not exempt as given above is taxable as perquisite. So what is not discussed above is taxable as perquisite. What about life insurance premium? This is also a perquisite. So payment by employer to effect an assurance on the life of employee or a contract for annuity is taxable. So if the employer pays life insurance premium on behalf of the employee, it is taxable as perquisite. However, if the employer makes contribution to a group insurance scheme, it is not taxable, it is exempt. So now we will deal with the next theme, which is on housing. And we will first talk about house rent allowance or HRA, in respect of which exemption is provided under section 1013A, rule read with rule 2A. Read with rule 2A. So exemption is provided in respect of HRA, which is granted by the employer to meet rent of residential accommodation occupied by the SSE. So the HRA should be granted by the employer. The HRA should be granted to meet rental expenditure. The rental expenditure should be for a residential accommodation which should be occupied by the SSE. Right? There are two negative conditions. If any of these conditions are satisfied, then exemption is not available. First is that residential accommodation is owned by the SSE. If the SSE himself owns the accommodation, what is it for which he is paying the rent? So exemption is not available. Secondly, exemption is not available if the expenditure is not actually incurred on payment of rent. So the payment of rent should actually be made, expenditure should actually be incurred on payment of rent. Only then exemption will be allowed, else exemption will not be allowed. So if all these conditions are satisfied, and the negative condition are not satisfied, there is no negative condition which is satisfied, then exemption is available. Otherwise, exemption is not available and HRA is fully taxable. Where the exemption is available, it is the lower of A, B or C. A is the actual HRA which is received, B is rent paid minus 10% of salary, and C is 40% of salary. And this 40% is increased to 50% for Mumbai, Kolkata, Delhi and Chennai. For all other cities, it is 40%. So exemption is lower of actual HRA received, rent paid minus 10% of salary, or 40 or 50% of salary. And what is the meaning of salary for this purpose? It is basic salary plus DA forming part of salary for computing retirement benefits plus commission, which is based on a fixed percentage of turnover. Okay. Now, few important points. All these calculations for A, B and C should be done for the period during which the accommodation is occupied by the SSE during the previous year. Because one of the conditions is that the accommodation should be occupied by the SSE. So even though HRA is being paid, but during that period for which HRA is being paid, the accommodation has not been occupied, the exemption will not be available. So the calculation for exemption should be done only for the period during which accommodation is occupied. So we should check the question and the facts carefully to check what is the period while which the SSE is occupying that accommodation in respect of which HRA is being paid. Second point which is important is only the salary. So while we compute 10% of salary or 40 or 50% of salary, what is the period for which we need to compute salary? So only the salary which is due for the relevant period, that means when the accommodation is occupied by the SSE, is to be considered for the purpose of calculating the exemption. Only the salary due, that means salary which pertains to that relevant period, is to be considered. So for example, it will not include any arrears. It will not include any arrears or advance, because if it is advance, the salary would be pertaining to say the next year or some subsequent period, right? And it will not pertain to the period while during which the accommodation is occupied. And similarly for arrears, right? So the arrears would pertain to some other period. So only the salary which pertains to the relevant period when the accommodation is occupied by the SSE is to be considered for calculation purposes. Now, if you carefully look at the formula, the exemption depends on 4 factors. The quantum of exemption depends on what? It depends on the amount of salary. It depends on the location, Mumbai, Kolkata, Delhi, Chennai, or some other place. It depends on the amount of rent that is being paid, and it depends on the amount of HRA that is being received. So 4 factors are relevant when you are applying this formula for computing the amount of exemption. So if any of the factors change during the previous year, right? So for example, rent may remain same throughout the previous year, but the amount of HRA may increase or decrease. Similarly, the amount of salary may increase or decrease. Or any of these factors, the location may change. If any of these factors change during the previous year, then we will need to create the buckets for those particular periods when all the 4 set of factors remain constant. And we will have to compute the exemption differently for those different buckets and then aggregate the exemption, right? So if any of these factors change during the previous year, exemption will need to be calculated separately for different periods based on different set of factors, and then at the end we can aggregate the exemption, and then that will be the total exemption for the previous year. We will now talk about valuation of perquisite on account of residential accommodation, and this is a perquisite P meaning it is a perquisite, and the valuation is done as per rule 3. And this is something that is depicted in this chart. How is valuation done in respect of rent-free residential accommodation provided by the employer? So an employer has provided accommodation to the employee, and it is in the nature of residential accommodation, and the employer is not charging any rent, so it is rent-free. So what is the taxable value of the perquisite on account of this? Situation 1, where the perquisite is provided by the employer, where the residential accommodation or where the rent-free residential accommodation is provided by the employer being the government. So where the employer is the government, it can be central government or state government, then the value, the taxable value is the license fee as determined by the government in respect of such accommodation. Where such accommodation is provided by any other employer, then it depends on whether the accommodation is owned by the employer or whether it is hired by the employer, that is taken on lease or rent by the employer. If it is owned by the employer, then the taxable value is what? It is a specified percentage of salary. A specified percentage of salary, and the specified percentage is either 7.5% of salary or 10% of salary or 15% of salary, and it depends on the population of the city in which accommodation is located. Up to 10 lakh, 7.5% of salary, greater than 10 lakh, up to 25 lakh, 10% of salary, greater than 25 lakh population, 15% of salary. On the other hand, if the accommodation is hired by the employer, then the taxable value is lower of what? The lease rental which is paid by the employer, or 15% of salary, that is the taxable value. The accommodation may be furnished. If the accommodation is furnished, then to this value, that means to this value or this value or this value, we need to add the following. What do we need to add? It depends on whether the furniture is owned or hired by the employer. If the furniture is owned by the employer, then we need to add what? 10% per annum of the cost. 10% per annum means then it depends on the period for which the furniture has been provided. 10% per annum is the rate, and this is computed on the cost, not on the written down value of the furniture. 10% per annum of the cost to the employer. If the furniture is hired by the employer, then we need to add the higher charges paid by the employer. Now this is the value for rent-free accommodation. What if the employee pays certain amount of rent, or where the accommodation is provided at a concessional rate? Then the value will be the value as we discussed above, the value as if it is provided rent-free. From this we reduce the rent actually paid by the employee, and that gives us the value of the perquisite. Now salary is an important component which needs to be figured out, because while for a government employer the value is the license fee and salary is not relevant, but for other employers the value is determined as a percentage of salary that comes into picture. So what is the amount of salary, what is to be included or excluded from salary becomes important. So let's see. Salary is taken in respect of the period during which the accommodation is occupied by the SSE, and this is the similar condition to what we discussed in respect of HRA. Therefore, advance of salary or arrears of salary which pertains to any other period is not to be included. Now, what are the inclusions and exclusions from salary? So, salary includes what? Salary includes the following items, and within brackets in bold you will see these alphabets B, B, A, C, D, M. So this is basically the mnemonic for learning for you, so that it may become easy for you to remember things easily. So B, B, A, C, D, M. So in salary we need to include basic salary, bonus, taxable allowances, commission, whether it is fixed or whether it is based on percentage of turnover, it doesn't matter. Dearness allowance, but only when it forms part of salary for computing retirement benefits, else not. And lastly, any monetary payment which is not in the nature of perquisite. Why? Because perquisites are supposed to be excluded. So if there is a monetary payment which is not in the nature of perquisite, it needs to be included in the meaning of salary. What are the items that we should not include in the salary? Salary excludes what? Salary excludes the value of perquisites. Salary excludes employer's contribution to Provident Fund, and it also excludes lump sum payments received on retirement. And the mnemonic for learning is PPR, which you can use if you want. Now, when we talk about residential accommodation, it basically also includes all these kinds of things like house, flat, farmhouse, hotel, motel, etc. When we talk about a hotel, it also includes things like motel, service apartment, or guest house, right? We saw above in the chart that the value of perquisite when the residential accommodation is provided by the employer in a hotel is also taxable to the extent of lower of actual charges paid to the hotel or 24% of salary. Lower of actual charges paid to the hotel or 24% of salary. However, perquisite in respect of stay in the hotel is not taxable. So there is an exemption which is provided. It is not taxable when? If the stay is for a limited period. That means it is provided for up to 15 days in the aggregate in the year. Up to 15 days when? On transfer from one place to another. So if the stay doesn't exceed 15 days in the aggregate, then the perquisite is not taxable, otherwise it is taxable. We saw above that if furniture is also provided, then the value needs to be added to the taxable value. What is furniture? Furniture includes all such items like TV sets, radio sets, refrigerators, other household appliances, air conditioning plant or equipment, or other similar appliances or gadgets. So all these items also need to be included. So this is how we determine the value of taxable perquisite on account of residential accommodation provided by the employer to the employee. So first we determine the value of rent-free residential accommodation, and it depends on whether the employer is the government or any other employer. Further, whether the non-government employer owns the accommodation or hires the accommodation, and we then determine the value, and to that we add a particular amount if the accommodation is furnished, and it depends on the amount to be added depends on whether the furniture is owned or it is hired by the employer. Taxable value also arises when the employer provides the residential accommodation in a hotel. After we have determined this value, then we need to reduce rent which is actually paid by the employee in order to determine the final value of taxable perquisite. And then we need to keep in mind the inclusions and exclusions in determining the amount of salary, and the mnemonic for learning is for inclusions it's BBACDM. If you want, you can use this, and for exclusions it's PPR. If you want, you can use this. The employer may provide the facility of gas, electricity or water to the employee, and this is also treated as a perquisite. So supply of gas, electricity or water to the employee for his household consumption. And what is the taxable value? It depends on whether this is supplied by an agency or whether it is supplied by the employer from own resources, right? Whether the employer is engaged in the supply of gas, electricity or water and therefore the employer is directly supplying it, or whether an agency is supplying it. If the agency is supplying gas, electricity or water, then the amount paid by the employer to the agency is the taxable value of perquisite. If the employer is supplying these from his own resources, then what is the value? The value is the manufacturing cost per unit to the employer. So once we determine this value, then we also need to reduce the amount, if any, which is paid by the employee in this respect, and that brings us to the value of the taxable perquisite. Similarly, where there is a benefit which is provided in respect of domestic servants, it's also treated as a perquisite. So the employer may provide the benefit of sweeper, gardener, watchman or a personal attendant to the employee, and that is taxable as perquisite. It is taxable as perquisite also where such benefit is provided to any member of the household of the employee. So if these benefits are provided not only to the employee but also to any member of his household, it is taxable as perquisite. And what is the meaning of member of household? It's something that we discussed at the beginning of this video. What is the value of perquisite? It is the salary which the employer pays for such services. So salary paid or payable by the employer or any other person on his behalf for such services. And of course, we need to reduce any amount which has been paid by employee in that respect. And that brings us to the amount of the taxable value. You need to note that if the employer is providing servant allowance, then it's fully taxable. No exemption is provided in that respect. So this brings us to the end of the theme on housing, and now we pick up the next theme, which is travel and conveyance. So we will first talk about certain special allowances in respect of travel and conveyance. Exemption is provided under section 1014 read with rule 2BB. Exemption is basically provided in respect of two categories of such special allowances. Category A, these allowances are specifically granted to meet official expenses, right? To meet official expenses. Category B allowances are generally granted to meet personal expenses at the place of duty or residence or to compensate for the increased cost of living. So talking first about category A, allowances, there are three kinds of allowances which are exempt: A1, A2 and A3. The popular name is traveling allowance for tour or transfer, daily allowance for tour or transfer, and conveyance allowance. And employee may be any employee, so all kinds of employees are covered by these allowances. What is the expense for which the allowance is granted? As far as traveling allowance for tour or transfer is concerned, it is granted to meet the expenditure on cost of travel. Cost of travel. When the employee is on a tour, right? When he has undertaken a tour for official purposes, so cost of travel on tour or cost of travel incurred on his transfer. So the employee is transferred from one place to another place and cost of travel on transfer is incurred and allowance is granted for that. And this includes not only cost of travel but also expenses on transfer, packing and transportation of personal effects, right? So this is the traveling allowance which is granted for tour or transfer, and it covers the cost of travel on tour or on transfer. Similarly, in respect of tour or transfer, there is a daily allowance which may be granted. And what kind of expenditure it covers? It covers the ordinary daily charges. The employee may incur the ordinary daily charges due to absence from normal place of duty. Why? Because he is on tour. So he is on a tour to some place and he is away. he is absent from his normal place of duty, and therefore to meet the ordinary daily charges and allowances granted. Or he is on a journey in connection with his transfer, right? He is on a journey in connection with the transfer, and for that period he needs to incur ordinary daily charges to meet those expenses and allowances granted. That is in category A2. And A3 is conveyance allowance, and this is granted to meet the expenditure on conveyance in the performance of official duties. So the employee is going from office to a client location, etc., and therefore for performance of official duties, the allowance is granted. In all these cases, A1, A2 and A3, what is the quantum of exemption? The quantum of exemption is to the extent expenses are actually incurred for the purpose for which the allowance is granted. So basically, the exemption is to the extent the expenses are incurred for official purposes for which the allowance is granted. So if, for example, conveyance allowance is granted of rupees 5,000 in a month, while the expenditure in performance of official duties on conveyance is 2,000 per month, so 2,000 will be exempt and the balance of 3,000 will be taxable. So this is the list of 3 items which fall under category A allowances. Now talking about category B allowances, which are generally granted to meet personal expenses. So there are 2 kinds of special allowances. So one is popularly called as disabled conveyance allowance, and this is exempt if it is given to a person who is blind or deaf and dumb or orthopedically handicapped. So basically a handicapped person, and it is granted to meet expenditure for commuting between residence and place of duty, right, in India. So if the commute is outside India, exemption is not available. If the commute from residence and place of duty and from place of duty to the residence to and fro is in India, then exemption is available up to 3,200 per month. This is the exemption. 3,200 per month is the amount of exemption. So expenditure for commuting between residence and place of duty in India. Second is a transport system allowance. Second special allowance is transport system allowance, and this is granted to an employee who is working in a transport system in India. For example, a bus transport system, right? There can be other examples, bus, metro, etc. So an employee, if he is working in a transport system in India, the employer provides an allowance to meet personal expenditure during his duty of running such transport from one place to another place. So the employee is working in a transport system in India and he needs to incur personal expenditure during his course of duty of running such transport from one place to another place. Then 70% of the allowance is exempt, subject to a maximum of 10,000 per month. The maximum can be 10,000 per month. So these are these 5 special allowances relating to travel and conveyance. Now what we need to know is, as far as category A allowance are concerned, there is no limit to the amount exempt, so long as the amount is spent for the stated purpose and the balance is taxable. So we are talking about category A allowances, and what is exempt is the extent to which expenses are incurred for official purposes, for the purpose for which the allowance is granted. So it depends on the amount of expenditure. It depends on the amount of expenditure, and there is no limit to the amount exempt, so long as this condition is met. But as far as category B allowance is concerned, which is B1 and B2, and what we note is that the exemption is limited to a certain level, which is 3,200 per month and 70% of allowance with a limit of 10,000 per month. So there is a limit. So therefore, the amount of expenditure is not relevant, and allowance in excess of exempt limit is taxable. Exemption is available regardless of the amount of expenditure. So if the disabled conveyance allowance, for example, is given of 10,000 per month, right? So 3,200 per month is exempt and the rest is taxable irrespective of the amount of expenditure. Further, as we have noted, the allowance is exempt only if the expenditure is in India. Now in A3, what we saw is conveyance allowance is exempt. Conveyance allowance, expenditure incurred on conveyance in the performance of official duties right? But if we talk about expenditure on commuting between residence and place of duty, it is not exempt, it is fully taxable. It is not covered here. It is not covered in A3. Rather, it is covered in B1, but that is only for the disabled, only for blind or deaf and dumb or orthopedically handicapped. If such is not the case, then the conveyance allowance, which is for commuting between residence and place of duty, is taxable. Transport allowance, if it is given, it is taxable if it is not exempt under any of the items which we have discussed. So only these 5 special allowances are given exemption to the extent specified above. Else, if transport allowance is given to an employee, it's not exempt, it is fully taxable. We will now see how to compute the taxable value of perquisite on account of leave travel concession, LTC. P means that this is a perquisite. An exemption is provided under section 10(5) read with rule 2B. So the value of any travel concession or assistance, and this is called leave travel concession or LTC popularly. So LTC may be received by an employee from the employer, and its value is taxable as a perquisite. So this is a benefit, its value is taxable as a perquisite. However, exemption is provided under rule 2B, which we will discuss. Now exemption is available in respect of what? It's available in respect of LTC received by employee from the employer. For what? For proceeding to any place in India, not outside India. So if the employee is visiting a foreign country, no exemption is allowed. For proceeding to any place in India when on leave. So employee has taken leave and then he is going on a vacation or on a holiday and he's proceeding to any place in India for travel. Or even after retirement or termination of service. So in that particular case, exemption is available under section 10(5) read with rule 2B. For whom is exemption available? Exemption is available when the travel is for the employee and his family. So either the employee should be traveling and his family can also travel along with him. But if it is the case that the employee is not traveling but only the family members are traveling, exemption is not available. And what is the meaning of family for this provision? It means 1, the spouse of the employee, 2, the children of the employee, and the spouse and children may be dependent, may not be dependent on the employee, it doesn't matter. But in 3, parents, brothers and sisters are covered only when they are wholly or mainly dependent on the employee. If they are not dependent on the employee, they are not considered as part of the family, and therefore exemption in respect of expenditure on their travel is not available. So spouse, children and parents, brothers and sisters who are dependent. As far as children are concerned, there is a limit. In respect of children which are born after this date, after 1st October 1998, exemption is available only up to a maximum of 2 children. Up to a maximum of 2 children who are born after 1st October 1998. Twins born after the first child are considered as one child. So the first birth is of, say, child A, and the second birth is of twins B and C. So A, B and C will be considered as 2 children. That means B and C will be considered not as 2 children but as one child. So effectively, in this particular case, the exemption will be available in respect of 3 children, A, B and C. However, if the first birth is of twins B and C and the second birth is of D, then B and C are already considered as 2 children and D will be the third child, in respect of whom exemption will not be available. Exemption will only be available for B and C, not for D, right? There is no limit on the number of children who were born on or before 1st October 1998. The limit of maximum 2 children is for children born after 1st October 1998. So this is the meaning of family. Now there is a concept of block. There is the concept of block which comprises a period of 4 calendar years. The idea is that the employee cannot undertake unlimited journeys and continue to claim exemption. So the idea is to restrict or limit the number of times exemption can be claimed in respect of LTC. And what is the limit? The limit has been provided for 2 journeys. So exemption is available only for a maximum of 2 journeys. 2 journeys undertaken when? Within a block of 4 calendar years. And the block runs in a manner that the current block is running from 2022 to 2025. And the next block therefore will be from 2026 to 2029. Right? So this is the calendar year, not the previous year, the calendar year. So within 2022 to 2025 year period, the employee can claim exemption for LTC on account of maximum 2 journeys within this particular period. There may be a situation where out of these 2 journeys, the employee is not able to undertake one or both of the journeys. So he may lose the benefit because this benefit may lapse if the period 2022 to 2025 gets over and the employee is not able to use this number of 2 journeys. So in that case, the benefit of carryover is provided. The benefit of carryover is provided. What it says is that if LTC is not availed during a block, if the employee doesn't avail the benefit of LTC during a block, say during the block 2022 to 2025, then it can be claimed in the next block also. It can be carried forward and it can be claimed in the next block, but not within the entire period of the next block, only in the first year. That means only in the year 2026, this carryover benefit is available. So if 2 journeys are available in the current block of 2022-25 and the employee avails LTC for only 1 journey and therefore 1 is not availed, so this balance 1 journey can be carried forward and it can be undertaken and LTC can be claimed in the first year of the next block, that is 2026. So effectively in such case what will happen in the next block, the employee will be able to claim the benefit in respect of this carry forward of 1 journey plus the 2 journeys which are otherwise available for this block, that is a total of 3 journeys. So this is the benefit of carry over. Now talking about the quantum of exemption, it basically depends on the mode of travel. How is travel done? By air, by rail, by bus, etc. What is the mode of travel? And the exemption, of course, cannot exceed the amount spent. And the exemption also cannot exceed a maximum specified limit. So there is a specified limit. And therefore, exemption is equal to what? It is equal to lower of either the amount spent on travel or the following amount, which is actually the maximum specified limit for exemption. Now we will see what is the maximum specified limit. And this depends on the mode of travel. Whether the journey is performed by air or the journey is performed by any other mode, for example by rail or by bus, etc. Where journey is performed by air, the maximum amount of exemption that can be claimed is the economy class fare of Air India for the shortest route. So we need to figure out what is the shortest route for travel. Then what is the Air India economy class fare? This is the maximum amount. If the journey is performed by any other mode, then it depends on whether the origin and destination are connected by rail or are not connected by rail. We need not check what is the actual mode of travel, but what we need to check is if the journey is performed by any other mode other than air, then what we need to check is whether the origin and destination are connected by rail, right? If the origin and destination are connected by rail, then the maximum specified limit is the amount of AC first class rail fare for the shortest route. So if the origin and destination are connected by rail, even though the journey may be performed by any other mode, for example by bus, but in that case also the maximum specified limit is this AC first class rail fare for the shortest route, right? If the origin and destination are not connected by rail, then of course the journey will not be performed by rail. In that case, what we need to check is where a recognized public transport system exists or where a recognized public transport system does not exist. For example, there may be a recognized government bus service point to point, and the origin and destination are not collected by rail. In that case, if there is a recognized public transport system, then the maximum specified limit is what? It is the first class fare or the deluxe class fare on such transport, the recognized public transport, by the shortest route. However, if even the recognized public transport system does not exist, so there is no rail connectivity and there is no connectivity either by way of a recognized public transport system, then what is the method? Then we need to assume as if the journey had been performed by rail. As if the journey had been performed by rail. What we need to do? We need to figure the distance of the journey by the shortest route. And then we need to compute, we need to figure out the AC first class rail fare. For that distance as if the journey had been performed by rail. So that becomes the maximum specified amount. So exemption is equal to lower of the amount which is actually spent on travel or the maximum specified amount depending on the criteria that we have discussed in this chart. Now what we need to note is the LTC exemption covers only the cost of travel. The employee may incur costs such as on accommodation, food, etc. But LTC exemption is only in respect of expenditure on travel, not on other kind of expenses on travel. We will now look at the valuation of perquisite on account of the benefit or facility of a motor car, and this is a perquisite P. 4 categories are there which impacts the valuation of the perquisite. Category A is a situation where there is use of motor car by the employee wholly for official use. Okay. Category B is a situation where there is use of motor car by the employee wholly for personal use. And this use is not only by the employee, but it may be also by any member of his household. Member of household is something the meaning of which we have discussed at the beginning of this video. Category C is where the motor car is used by the employee or any member of the household, and the use is a mixed use, that is partly official and partly personal. And category D is the category where any other automotive conveyance, that is other than motor car, for example motorcycle, scooter, etc., is owned by the employee and it is used by the employee. So we will look at these 4 categories now and how is the valuation done for the perquisite. The first category is where the motor car is used by the employee wholly for official use. In such case, no perquisite arises. Perquisite is exempt because the use is wholly official. However, there is the condition. The condition is that the documentation conditions should be fulfilled. Documentation conditions should be fulfilled. And what are the documentation conditions? There are 2 documentation conditions. The employer has maintained complete details of official trips. So all the official trips, the complete details have been maintained by whom? By the employer. And then the employer has given a certificate to the employee to the effect that the expenditure was incurred wholly for official purposes. So all details are maintained and a certificate is given to the employee. In such case, the employee won't be taxed in respect of the value of the perquisite and it will be exempt if the use is wholly official use. Now we come to category B where the use is wholly personal, and in such case the benefit will arise or the perquisite will be arise and it will be the perquisite will arise and it will be taxed even when the motor car is used by any member of the household of the employee. And the taxable value of the perquisite will be determined as given in this table. So if the motor car is owned by the employer, then 10% per annum of the actual cost of the motor car needs to be added. This is basically on account of wear and tear. Actual cost, not the written down value of the motor car. and 10% per annum. By per annum we mean that it depends on the duration for which the motor car has been used by the employee. So at this rate, the amounts needs to be added. However, if the motor car is hired by the employee, then the higher charges paid by the or incurred by the employer need to be added. Running and maintenance expenses need to be added if they are incurred by the employer. Chauffeur's remuneration needs to be added if it is paid by the employer. So all these amounts are basically in the nature of expenditure incurred by the employer or on account of wear and tear of the motor car. And then we need to reduce what? We need to reduce any amount which has been charged from the employee or which the employee has paid, and this results in the taxable value of perquisite. So this is the valuation done where the motor car is used by employee or any member of his household wholly for personal use. Now we come to category C, where the use of motor car is by the employee or any member of his household, and the use is a mixed use, that is partly official and partly personal. And the valuation basically depends on who owns the motor car and who bears the expenses. And this is explained in this table. Who owns the motor car? In the situation, the employer owns the motor car, and this also covers a case where the employer has hired a motor car from someone else. In both these situations, so where the employer owns or has hired the motor car and who is bearing the running and maintenance expenses, the running and maintenance expenses are met or reimbursed by the employer. So employer is the person who is bearing the expenses. So where the employer owns the car and also bears the expenses, then what is the value? The value is the fixed amount per month. It is 1,800 per month. If the cc is what? The cubic capacity of the engine of the motor car. If the cc of engine is up to 1.6 liters, then the value is 1,800. If the car is a big car, that means if cc is greater than 1.6 liters, then the value rises to 2,400 per month. If chauffeur is also provided to run the motor car, then an extra 900 per month needs to be added to the value. So this is the value where the employer owns the motor car and also bears the expenses. The other situation is where the employer owns the motor car, but the employee is bearing the expenses, the running and maintenance expenses. Now, since the employee is bearing the expenses and the employer only owns the motor car, then the value is a reduced amount per month. Instead of 1,800, it becomes 600 per month. Instead of 2,400 per month, it becomes 900 per month. And in case chauffeur is also provided, then the amount remains the same at 900 per month. So this is the value per month which is to be attributed as the taxable value of the perquisite. Now what we need to note is valuation is done at these rates irrespective of the actual expenses on official use. So mind you, we are talking about a mixed use, but whatever be the amount on official use, whether it is 80%, 70%, 90%, the ratio on official use and the actual expenses on official use, it doesn't matter. This is the fixed amount per month in terms of value. Or the amount charged from the employee, whatever the employee might have paid on account of use of motor car, it also doesn't matter. Or the amount of expenses borne by the employer or the employee, whatever be the amount of running and maintenance expenses, it also doesn't matter. These are the values per month on the basis of which valuation of perquisite is supposed to be made. Now we come to a situation where it's not the employer but the employee who owns the motor car. So the employee owns the motor car and the expenses are borne by the employer. Employer is only bearing the expenses. So how do we go about doing the valuation? We first pick up the actual amount of expenditure incurred by the employer, right? Because that is ultimately the benefit which is being provided to the employee, the expenditure incurred by the employer. So we pick that first and then we reduce that by the following amounts, right? And why do we do this reduction? Because these are the amounts which we are attributing towards the official use, because we are talking about mixed use. So first we pick up the expenditure by employer and then we assume that this amount per month is attributable towards the official use, and therefore we reduce it from the taxable value of perquisite. So 1800 per month is reduced if cc of engine is up to 1.6 liters. This rises to 2400 per month if cc of engine is greater than 1.6 liters, and if chauffeur is also provided, we further reduce 900 per month. Now if it is claimed, if the employee claims that no, this 1800, 2400, 900 is too less, and what has been incurred for official purposes is much higher than this, and therefore a greater amount should be reduced, so that can be claimed. A higher amount can be claimed as a deduction on account of official use, but the condition is that the documentation should be maintained. And what are those documentation conditions? They are the same as we discussed for the purposes of use of motor car for wholly official purposes. Last situation could be that the employee owns the motor car and also bears the expenses. In that case, actually there is no perquisite because there is no benefit to the employee because he is owning the motor car and he is bearing the expenses. So there is no benefit to the employee given by the employer, so no perquisite arises. Now there could be a situation where more than one motor car has been provided to the employee. More than one motor car, which may be either be owned by the employer or may be hired by the employer, is provided to the employee or any member of his household for use. Not being, and this is not a case where the use is wholly official, because in that case perquisite won't arise in the first place. So it covers cases where more than one motor car is being provided and the use is either wholly personal or it's a mixed use. So how is the value computed? 1. We pick up one motor car and the value for that one motor car is to be computed as if it was provided for mixed use, as per mixed use. And we look at the valuation where the motor car is owned by the employer and expenses are met or reimbursed by the employer. So basically category C above. So for one motor car, the valuation is done as per category C, where the employer owns the motor car and also bears the expenses. So these are the values that need to be taken, and this is the value which needs to be picked up for one motor car. Second, for the other car or other cars, the valuation is done as if the motor car has been provided wholly for personal use as per category B. So for other motor cars as per category B, this is how the valuation is supposed to be done. So this is the approach that we need to follow when more than one motor car has been provided. Now we come to category D. What situation would this cover? This situation would be covered where the employee owns the automotive conveyance and the expenses are met or reimbursed by the employer. Right? Now there could be a situation where the automotive conveyance is used for wholly official purposes. In such case, the perquisite is exempt, but provided the documentation conditions as we have discussed are fulfilled. The other situation could be of mixed use, partly official and partly personal. In which case, what do we need to do? Just like in the case of motor car, first we need to pick up the actual amount of expenditure incurred by the employer. And then we need to reduce 9,000 per month, assuming that this is the amount attributable towards official use. However, the employee can also claim a higher amount of deduction, higher than rupees 900 per month on account of official use, provided the documentation conditions are fulfilled. So this is how we make the valuation under categories A to D. Some important points to note. Valuation of perquisite is done based on the months of use. So if the motor car or the conveyance is used for 2 months, the valuation is done for 2 months. If it is used for 10 months, the valuation is done on the basis of 10 months, right? So the figures like 900 per month, 1800 per month are the monthly valuation figures. and the valuation is done based on the total months of use. Second point, use of motor car is covered by this rule. Sale of motor car is not covered by this rule. Sale of motor car is covered under another rule which deals with transfer of movable asset, which we will talk in some time. Third, use of any other vehicle owned by the employee is covered under this rule. So as we saw, apart from motor car, use of any other automotive conveyance is covered by this rule if it is owned by the employee, not by the employer, right? If there is use of any other vehicle, for example, motorcycle, etc., which is owned by the employer, then that is not covered by this rule. It is covered by use of movable asset rule, which we will discuss in some time. There is a specific exemption provided in a particular situation. An employer may provide a vehicle to the employee for undertaking journeys between his residence to the office or other place of work. And this is exempt, this is not taxable as a perquisite. So use of any vehicle which is provided by an employer for journey by the SSE between what? Between residence and office or other place of work is not taxable. This is what we need to keep in mind. So these are the valuation rules in respect of a motor car or in respect of any other automotive conveyance owned by the employee. The employer may be a transporter who is engaged in the carriage of passengers or goods, and such transporter may provide the facility of such transport to his employees for their personal or private journeys, not only to the employee but also to any member of the household of the employee, and it may be provided free of cost or at concessional rate. This gives rise to a perquisite. How is the valuation done? Let's see. So the benefit or amenity is by way of personal or private journey provided to the employee or member of the household, and it is provided by the employer who is engaged in the carriage of passengers or goods, basically a transporter. Now if the employer is the airline, for example Air India, Indigo, Vistara, etc., or the railways, Indian Railways, in such case, if such transporter is providing free or concessional facility or amenity in terms of journey by the transport in which such transporter employer is engaged, then no perquisite arises, taxable value is nil. In the case of any other employer, for example an employer who is engaged in bus transport, there arises a taxable value. And what is the value? The value is the value at which such benefit or amenity is offered by the employer to the public, and we of course need to reduce the amount which is paid by or recovered from the employee. So if it is a case of concessional fare, then we need to reduce the amount that the employee has paid, and the result becomes the value of the taxable perquisite. Then there may be a case where, say, a holiday home facility is maintained by the employer, and there is this benefit on account of traveling, touring or accommodation on a holiday, and this gives rise to a perquisite as well. So there is this value which is provided by the employer where the benefit is on account of traveling, touring, accommodation, or say any other expenses which are borne by the employer or reimbursed by the employer. For what? For any holiday which is availed of by the employee, and not only by the employee, also by any member of his household. In such case, the value is taxable as perquisite. And how is the valuation done? It depends on the situation which is covered. If, say, the facility where the employee is enjoying his holidays, if that is maintained by the employer, and that facility is not available uniformly to all the employees, that means the employer maintains that facility and this facility is provided specially to the employees. In such case, it's not the expenditure incurred by the employer which is the taxable value. Rather, it is the value at which such facilities are offered by other agencies to the general public. That means we are now trying to capture the market value. So the market value basically of such facilities becomes the taxable value. Value at which such facilities are offered by other agencies to the public. If this is not the case, that means in any other case, the taxable value is the expenditure which is incurred by the employer, of course, reduced by the amount which is paid or recovered from the employee. So this brings us to the end of this particular theme. And now we move to the next theme, which is on education. We will now first look at special allowances granted in relation to education, and the exemption is provided under section 1014 read with rule 2BB. Category A allowances are those allowances which are specifically granted to meet official expenses, and here the allowance is popularly called as a research allowance, and it's granted in relation to which expense? For encouraging the academic research and training pursuits in educational and research institutions. And the exemption is to the extent expenses are actually incurred for the purpose for which the allowance is granted. So for this category, there is no limit to the amount exempt, so long as the amount is spent for the stated purpose and the balance is taxable. Category B allowances are those allowances which are granted to meet personal expenses at the place of duty or residence or to compensate for the increased cost of living, and there are two allowances in relation to education. The first is children education allowance, and it is with respect to children education in India. The exemption is 100 per month per child up to a maximum of 2 children. The second is children hostel allowance, and it is for hostel expenditure on a child in India, and the exemption is 300 per month per child up to a maximum of 2 children. So a maximum of 2 children can be covered by the exemption. As far as category B is concerned, the allowance in excess of exempt limit is taxable, and exemption is available regardless of the amount of expenditure. So if 500 per month is provided for a child to meet the education expenses, where the education is in India, then only 100 rupees per month is exempt. The balance 400 per month will be taxable, right? And this is regardless of the amount of expenditure. Further, we need to note that both the children education allowance and children hostel allowance are not exempt where education or the hostel is outside India. This is the important point. If the education or the hostel is in India, only then the exemption is available. We will now look at the perquisite on account of educational facility. On account of educational facility, and this is a perquisite P, and the valuation is done as per rule 3. Now the value of benefit to the employee resulting from the provision of free or concessional educational facilities, and this may be provided by the employer to any member of his household. What is member of the household of the employee is something that we have discussed at the beginning of this video. In this context, it mostly means the children of the employee. So if the employer provides free or educational facilities for the children or for any other member of the household of the employee, that is taxable as perquisite, subject to a threshold exemption limit. However, benefit in the nature of educational facility or training to the employee himself is exempt. So basically, if the employer provides educational facility or training to the employee, then no taxable value arises and the perquisite is exempt. But if educational facility is provided by the employer for any member of the household of the employee, then how is the valuation done? 3 situations may arise. Situation A, where the employer owns and maintains the educational institution, where the educational facility is provided in educational institution itself maintained and owned by the employer. So it's employer's own educational institutions. In such case, the value is the cost of education in a similar institution in or near the locality. So we need to find out the cost of education in a similar institution, similar to the employer's institution, in or near the locality. And there is a threshold of 1000 per month. So the perquisite is exempt. Perquisite is exempt if the cost of such education or the value of such benefit per child is up to 1000 per month. So if the value is up to 1000 per month per child, then taxable value doesn't arise, perquisite is not taxable. Then there is a situation B, where the educational facility is provided in an educational institution where the employer has a tie-up, right? And thus the facility is allowed by reason of employment with that employer. So the SSE is the employee of the employer, and the employer has a tie-up with an educational institution where the educational facility is provided to the member of household, or say the children of the employee. Okay, so there is a connection, there is a link. And there also the valuation is done on similar lines. The value is the cost of education in a similar institution in or near the locality. And a similar threshold of 1000 per month is provided, where the perquisite is exempt if the cost of education or the value of the benefit per child is up to 1000 per month. If the case is any other case, that means neither the institution is owned and maintained by the employer, nor the employer has a tie-up with such educational institution. So it basically reflects the general case. In that particular case, the value of perquisite is the amount of expenditure which is incurred by the employer. In all these three situations A, B, C, the reduction is to be made of amount paid or recovered from the employee, and what the balance is, it's the taxable value of the perquisite. Certain points that we need to note. Now, we noted that there is a threshold of 1000 per month, which is the exemption. So exemption limit of 1000 per month is only for a child. It's not for any other member of household. Member of household comprises of other persons as well apart from the children. But this 1000 threshold is only for a child. So if the educational facility is provided not for the child but for any member of the household, then this threshold doesn't apply. Whatever be the value, it is taxable. Second point, the exemption of 1000 per month does not apply to category C. So in the general situation, the expenditure incurred by the employer is the taxable value of the perquisite. Even if it is below 1000 per month, it doesn't matter. Now, as far as the threshold of 1000 per month is concerned, there are two views. As per view 1, the entire value is taxable if it exceeds 1000 per month. So if the value is 5000 per month, 5000 per month becomes the taxable value of perquisite. However, as per view 2, only the value in excess of 1000 per month is taxable. So if the value is 5000 per month, then after considering exemption threshold of 1000 per month, only 4000 per month is taxable. The view which is generally followed is view 1, which is the entire value is taxable if it exceeds 1000 per month. But whatever view you follow in your answer, you should clearly state the view that you are following by way of a note in the answer. And both the views are alternative views, but mostly or generally view 1 is what is followed. Lastly, cost of education in a similar institution is not relevant for category C. So when we are talking about category C, the general category, then what is relevant is the expenditure incurred by the employer, and cost of education in a similar institution may be lower or higher, it doesn't matter. We now move to our next theme, and we will cover the perquisites which arise on account of assets. And the perquisite can arise either on account of use of movable asset or on account of transfer of movable asset. So first we will look at the perquisite arising on account of use of movable asset. P means it's a perquisite and the valuation is done as per rule 3. The employer may allow use of a movable asset, and in such case perquisite arises, and now we will see how is the taxable value determined. And the use can be not only by the employee but also by any member of the household of the employee. In such case, if the movable asset is laptop or computer, then no taxable value arises and the perquisite is exempt. In case the use is of any other asset, that means other than laptops and computers, then the valuation depends on whether the movable asset belongs to the employer or whether it is hired by the employer. Where the movable asset belongs to the employer, then the value of taxable perquisite is 10% per annum of the actual cost. Actual cost is relevant, not the written down value, and 10% rate is applied on a per annum basis. That means depending on the duration of the use. So value is 10% per annum of actual cost. If the movable asset is hired by the employer, then the value is the higher charges which have been incurred by the employer. Of course, in both the cases, we reduce the amount paid or recovered from the employee, and the balance is the taxable value of perquisite on account of use of movable asset. Now, there could be a special rule where a use of a movable asset is covered. For example, use of motor car. But since there is a special rule, this rule that we are talking about, it doesn't apply to use of motor car. For other movable assets, this rule applies. Now, the nature of use is not relevant. Nature of use is not relevant. Thus, a laptop computer usage is exempt even if laptop and computer is used for personal purposes. Even if it is used for personal purposes, even then it is exempt. Similarly, the value of perquisite arising on account of other assets is taxable even if those other assets are used for official purposes. So the nature of use is not relevant. The valuation on account of use of movable asset is done as per this rule. Taxable value of perquisite also arises when there is transfer of a movable asset, and this is also a perquisite, and valuation is done as per rule 3. So the employer may transfer a movable asset which is belonging to the employer, and the asset may be transferred not only to the employee but also to any member of the household of the employee, and in that case the perquisite arises. And how is the taxable value determined? First, we find out the actual cost of the movable asset to the employer. Okay, the cost at which the employer acquired the movable asset, so that is the actual cost. From that, we reduce the depreciation, and finally we reduce the amount which has been paid or recovered from the employee, and this gives us the taxable value of perquisite. Now, as far as depreciation is concerned, which we need to reduce while figuring out the value of the perquisite, the depreciation is computed for each completed year during which the asset was put to use by the employer. So if, say, the employer does not put to use the movable asset, the employer purchases and immediately transfers the movable asset to the employee, then there is no use and hence no depreciation is required to be deducted. Similarly, if the employer puts the movable asset to use only for, say, a part of the year, for example, the employer acquired the asset and after 6 months the employer transferred the asset to the employee, then also there is no completed year of use and therefore no depreciation will be deducted. So depreciation, what we need to keep in mind is that depreciation for each completed year during which the asset was put to use by the employer. And what is the rate of depreciation and the method of depreciation? It depends on the category of movable assets. So first is computers and electronic items, in which case depreciation is provided at the rate of 50% on reducing balance method. That means we reduce the depreciation. This is the original cost. We reduce depreciation. Then that brings us to the written down value. And then from that, we again reduce 50% and so on. So the balance keeps reducing. So this is called reducing balance method. Then comes motor car. Transfer of motor car. And mind you, use of motor car, the valuation is something that we discussed some time back. But this is not use of motor car, this is transfer of motor car. In such case, reduced rate of 20% applies, but the method remains the same at reducing balance method. As far as any other asset is concerned, not being computers, electronic items or motor car, in that case, a further reduced rate of 10% applies and the method changes from reducing balance to the SLM or the straight line method. Now, as we noted, in case of electronic items, 50% depreciation or reducing balance method is to be allowed. So the question arises, what is the meaning of electronic items? So there is a circular which has been issued and which says that electronic items means data storage and handling devices. Like what? Like computer, digital diary, printers. These are classified as electronic items. Data storage items and handling devices. However, electronic items does not include household appliances. Household appliances like washing machine, microwave oven, mixer, hot plate oven, etc. So these household appliances, even though they run on electricity, they are not classified as electronic items. Rather, they fall under this category of any other asset, and 10% depreciation on SLM method is provided on household appliances. We now look at the perquisites in respect of office support. First, we will look at special allowances. which are exempt by virtue of section 1014 read with rule 2BB. And these are specifically granted to meet official expenses. Two such special allowances are there. The popular name is helper allowance and uniform allowance. Helper allowance is granted to meet expenditure incurred on a helper where such helper is engaged for the performance of the official duties, not a personal helper. If a personal helper is engaged, then exemption is not available. The allowance is fully taxable. However, where the helper is engaged for official duties, then what is the amount of exemption? To the extent expenses are actually incurred for the purpose for which the allowance is granted, right? So the allowance is exempt to the extent of official expenses incurred for this particular purpose. Similarly, we have a uniform allowance which is granted in respect of expenditure incurred on purchase of maintenance of uniform for wear during the performance of official duties, right? So if the allowance is granted for purchase of uniform or for purchase of clothing, not for official duties but for personal purposes or any other purpose, then exemption is not available. Otherwise, the exemption is available where the expenditure is on purchase of maintenance of uniform for official purposes. And just like helper allowance, the exemption is to the extent expenses are actually incurred for this purpose. So in both the cases of helper allowance and uniform allowance, there is no limit to the amount exempt so long as the amount is spent for the stated purpose and the balance is taxable. So there are two special allowances granted in relation to office support. Now we will look at the value of perquisite provided on account of food and beverage facilities. And this is P, that means the perquisite and valuation is done as per rule 3. How is the valuation done? It depends on the category of the benefit which is provided. So food and beverages provided by the employer. Food and beverages provided by the employer. In the case of tea or snacks provided during working hours, not during non-working hours, but during working hours, if tea or snacks are provided, then there is no taxable value of perquisite that arises and it is exempt. What about food and non-alcoholic beverages? Non-alcoholic beverages like fruit juices, fruit drinks, shakes, etc. Food and non-alcoholic beverages which are provided by the employer during working hours. At which place? At the office or business premises. So if the employer provides these facilities, food and non-alcoholic beverages during working hours and at the office or business premises, then what is the value? The value is the expenditure incurred by the employer. Expenditure incurred by the employer, and there is an exemption of rupees 50 per meal that is allowed. So minus rupees 50 per meal. And then of course we reduce the amount paid or recovered from the employer. So expenditure incurred by the employer minus rupees 50 per meal minus amount which is paid or recovered from the employee is the taxable value of perquisite. Similar is the valuation where food and alcoholic beverages is provided through what? Through paid vouchers. So many a times the employer provides paid vouchers to the employee which are non-transferable, which cannot be transferred by the employee and which are usable only at the eating joint. So there are specified eating joints where the employee can go and use these vouchers or redeem these vouchers, and the employer incurs an expenditure in providing those vouchers. So what is the valuation? The valuation remains the same. It is the expenditure incurred by the employer minus rupees 50 per meal and minus the amount which is paid or recovered from the employee. Now this situation covered a case where food and non-alcoholic beverages is provided during working hours, where at office or business premises. There can be a situation where this is provided not at the office or business premises but in a remote area or an offshore installation. In a remote area or in an offshore installation, right? In such case, no taxable value arises and the perquisite is exempt. And this is the residual case, which is the any other case, that means not falling in the preceding categories. In such case, the valuation is simple. The valuation is what? It is expenditure incurred by the employer and minus the amount paid or recovered from the employee. Now, 2 points that we need to note is alcoholic beverages are fully taxable. So, if alcoholic beverages are provided, exemption See, this perquisite valuation applies to non-alcoholic beverages. Non-alcoholic beverages. So if alcoholic beverages are provided, then such perquisite is fully taxable. Further, if an allowance is provided, which could be called a lunch allowance or dinner allowance or tiffin allowance or by any other name, then that allowance is fully taxable. So this is the valuation as far as food and beverages is concerned. Now, perquisite may arise on account of telephone, and P means perquisite and valuation is done as per Rule 3. Now, if the employer bears the telephone expenses on behalf of the employee, if employer bears the telephone expenses, so expenses on telephone, and this includes a mobile phone as well, expenses on telephone which are actually incurred by whom? By the employer on behalf of the employee, right? So the employer is bearing the telephone expenses. It includes mobile expenses as well. That is exempt. Taxable value doesn't arise. Therefore, if the employer pays or reimburses the telephone bills of the employee, it is not taxable. However, what we need to note is, if say a telephone allowance is provided to the employee, which the employee uses to meet his telephone expenses, then that is not exempt. Telephone allowance is fully taxable. Okay, we now look at the theme of financial incentives, and we first take a look at the perquisite arising on account of provision of loan to the employee. And the loan may be an interest-free loan or it may be provided at a concession rate. Valuation is done as per Rule 3 and it is a perquisite. Let's see how is the valuation done. So we are talking about a loan which is interest-free or which is provided at a concessional rate. And the purpose can be any purpose, and it's made available to whom? To the employee or even to any member of the household of the employee. By whom? By the employer or even by any person on behalf of the employer. So the perquisite arises, and for doing the valuation we follow this approach. First, we need to see whether the amount of loans are petty, being up to rupees 20,000 in the aggregate. So petty loans means small loans. So where small loans are provided during the course of the year such that the aggregate of those loans doesn't exceed rupees 20,000 in the year in the aggregate, then taxable value doesn't arise and the perquisite is exempt. If that is not the case, then we need to further check whether the loan was made available for medical treatment in respect of prescribed diseases which have been prescribed under Rule 3A. Okay, the list of prescribed diseases is not relevant for us, but what we need to know is that if the loan is for medical treatment, if it is a medical loan and the treatment is of a prescribed disease, then also taxable value doesn't arise, the perquisite is exempt from tax. Now here we need to keep in mind the fact that in certain cases, the employee may also get reimbursement from the insurance company on account of medical treatment. So on the one hand, he is taking the interest-free or concessional loan from the employer, which is exempt. And on the other hand, he is also getting the insurance claims. So that is not justified, and therefore it is provided that in such case, exemption does not apply. Exemption does not apply to what? To so much of the loan as is reimbursed under a medical insurance scheme, right? So if the loan is taken of 1 lakh rupees, out of which rupees 40,000 is reimbursed by the insurance company, then the balance of 60,000 is exempt. No taxable value of perquisite arises. However, in respect of 40,000, exemption is not available and we need to compute the taxable value. Now, if both these situations of exemption is not applicable, then taxable value arises. Then the taxable value for the perquisite arises. And then how do we need to value the perquisite? The value of perquisite is interest benefit multiplied by the maximum outstanding monthly balance. Interest benefit is the benefit on account of interest. And we need to first figure out the actual interest which is charged from the employee. If it is interest-free loan, then it will be 0%. Or if it is a concessional rate loan, then the actual interest which is charged. And then we need to benchmark this against a rate which is charged by the State Bank of India as on 1st April in respect of loan for the same purpose. So if it is a consumer loan, then we need to figure out what is the rate of interest that SBI charged on 1st April of the relevant previous year for a consumer loan. So that becomes the benchmark rate. And then from that we reduce the actual rate which is charged from the employee, and that gives us the amount of interest benefit. Now we need to multiply this interest benefit by what? By the maximum outstanding monthly balance of the loan, maximum outstanding monthly balance. So we need to compute this on a monthly basis. And what is this? This is the aggregate of what? Aggregate of outstanding balance for each loan. So there may be multiple loans, so we need to make the computation for each loan separately, and we need to aggregate that. What we need to do for each loan, we need to figure out the outstanding balance as on the last day of each month, and then we need to aggregate that, and then we need to multiply it by the interest benefit, which will give us the taxable value of perquisite. Just to understand this, we'll just take two examples very quickly. So there is an illustration. We are not covering the whole of the illustration, but for example, we take case 3 here. And for example, the interest-free loan is given. For which the State Bank of India lending rate is say 12% on 1st April of the previous year. So the interest benefit becomes 12% because 12% minus nil actual rate of interest is 12%. So 12% becomes the interest benefit, and this loan is say of rupees 5 lakh, and it is given on say 1st of October. So for the previous year it's given for a period of 6 months, and if it is provided that no repayment of principal is made during the previous year. If no repayment of principal is made during the previous year, then basically what this means? This means that if you compute the maximum outstanding monthly balance for those 6 months, it will remain the same. It will remain the same because there is no repayment of principal. In that case, we need not compute the monthly outstanding balances for each month separately. What we simply need to do is to compute 12% of the loan of 5 lakh for a period of 6 months, which gives us 30,000, which is the taxable value of perquisite. So in a case where the maximum outstanding monthly balance is same across all the months, it's very simple. We just need to figure out the total interest payable for that year, and therefore in this case the taxable value of perquisite also becomes 30,000. However, we need to follow a different approach where the principal is repaid on a monthly basis, and therefore the maximum outstanding monthly balance reduces or it changes with every month. In that case, let's take an example. For example, 5% is the interest rate charge for a loan which is provided by the employer, as against which the SBI rate as on 1st April of that year is 15%. So interest benefit becomes 10%, right? Say the loan which is given is of 10 lakh rupees. The loan which is given is of 10 lakh rupees, out of which rupees 1 lakh on account of principal is repaid on 1st of every month. Okay, so the loan is 10 lakh, 1 lakh is repaid on the 1st of every month, and say the loan is taken on 1st of December 2022. On 1st of December 2022. Okay, and the interest rate benefit is 10%. So now we need to figure out the maximum outstanding monthly balance. That is the outstanding balance of loan as on the last day of each month. So since we take the loan on 1st of December, we figure out this particular amount for the month of December to March. So for December, the loan amount was 10 lakh, and since the repayment is made on 1st of every month, so the first repayment of 1 lakh will be made when? On 1st January 23. So therefore, the outstanding balance as on the last day of December will remain 10 lakh. But for January, it will go down to 9 lakh, for February 8 lakh, for March 7 lakh, right? And we aggregate this. So this is the aggregate of the maximum outstanding monthly balances for each month. And now we compute the taxable value of perquisite as 10%, which is the interest benefit, multiplied by 34 lakh, which is the aggregate of maximum outstanding monthly balances, into 1 by 12. So we divide this by 12 because we are computing the these figures on a monthly basis. And the result is 28,333, which is the taxable value of perquisite. So either we can do it this way. That means we first pick up the aggregate of all these monthly maximum outstanding balances on the last day, and then we multiply it by the interest benefit and divide by 12. Or alternatively, we can do it on a monthly calculation basis as well. So the same thing for December, January, February, March, the maximum outstanding monthly balance is 10 lakh, 9 lakh, 8 lakh, 7 lakh, same as above. But here we make the computation of interest for each month. So on 10 lakh, we compute the interest at the rate of 10% for 1 month. Similarly, at the rate of 10% for 1 month on 9 lakh, on 8 lakh, and on 7 lakh. So this is the interest for each month separately, and then we aggregate. So this amount will come same as 28,333. So we can follow either of the approaches, but the concept remains the same. And the concept is that when we are valuing the taxable perquisite, then it will be interest benefit into maximum outstanding monthly balance. And maximum outstanding monthly balance will be the aggregate outstanding balance for each loan if there are multiple loans, or for that loan itself if there is a single loan, as on the last day of each month. So this is how we compute the taxable value of perquisite on account of interest-free or concessional loan. Now, in case employee stock option or ESOP is provided by the employer to the employee, then also perquisite arises by virtue of section 17(2)(6). So the employer or even a former employer may allot or transfer directly or indirectly what? A specified security or sweat equity shares to the employee, and it may be done either free of cost or at a concessional rate. Then taxable value of perquisite arises. This is taxable as perquisite. So when a specified security or sweat equity share is allotted or transferred by the employer to the employee, then perquisite arises. And it can be either free of cost or at concessional rate. What is the taxable value? The taxable value is basically the fair market value or the FMV of such specified security or sweat equity share. So fair market value is the taxable value, but fair market value as on what date? On the date on which the option is exercised by the SSE. On the date on which the option is exercised, date of exercise of the option is relevant. FMB on that date is supposed to be taken as the taxable value. Of course, we reduce the amount actually paid by or recovered from the SSE. Right? Now, what we need to note is the year in which the perquisite is taxable. So perquisite arises when the specified security or sweat equity shares are allotted or transferred. So perquisite is taxable in the year of allotment or transfer, right? While when we compute the taxable value, what is relevant is the fair market value, not on the date of allotment or transfer, but on the date of exercise of the option by the SSE. This is something that we need to note. And therefore, fair market value is not relevant on the date of grant of option. It's not relevant on the date of vesting or on the date of allotment transfer. Fair market value is not relevant. Fair market value is on the date of exercise of the option is relevant. So this is how we compute the taxable value on account of ESOP, and we charge it under the head salaries. But capital gains arise when the SSE subsequently transfers or sells these shares or securities. So when these are subsequently sold, capital gains arise, and this is something that we will discuss in detail in the video on capital gains. In that case, since the FMV has been taken as the basis for computing the taxable value of perquisite under the head salaries, the same value is then taken as the cost of acquisition for computing capital gains, and therefore this completes the loop. The value of gift, voucher or token is also taxable as perquisite and valued as per rule 3. Now, if any gift is provided or voucher is provided or a token is provided by the employer to the employee or even to the member of household of the employee, whether on ceremonial occasions or otherwise, it is taxable as perquisite. Perquisite arises. Gift or voucher or token provided not only to the employee but even to any member of the household. And taxation depends on whether this is in cash or in kind. If it is in cash, then it is fully taxable. No exemption is allowed. It is fully taxable. If it is in kind, then there is a threshold exemption of 5,000 which is provided. So we need to check if the value is less than 5,000 in the aggregate during the previous year, right? Gifts, voucher or token in kind. If the value is less than 5,000 in the aggregate during the previous year, then taxable value doesn't arise, it is exempt. If the value exceeds 5,000, if the value is 5,000 or more in the aggregate during the previous year, then it is fully taxable. So as far as gifts, voucher or token are concerned, if it is in cash, it is fully taxable. If it is in kind, it is also fully taxable if the aggregate value during the previous year is 5,000 or more. If it is less than 5,000, then it is exempt, it is not taxable. Now as far as the limit of 5,000 is concerned, there are two views. As per view 1, if the value is 5,000 or more, then the entire value is taxable. The entire value is taxable. However, as per view 2, if the value is 5,000 or more, then only the value which is in excess is taxable, right? For example, if it is 6,000, then as per view 1, the entire 6,000 becomes taxable. As per view 2, only the excess which is 1,000 becomes taxable. Generally, view 1 is adopted, but you can adopt view 2 as well by giving a note in your answer and clearly stating the view that you are following. So we would note that the threshold of 5,000 is not available for cash gifts because cash gifts are fully taxable. Further, the threshold of 5,000 is seen in the aggregate, not for each gift separately. What about gift check? Sometimes the employer may give a gift check to the employee. Now that is not gift in kind, it is equivalent to a cash gift and therefore threshold of 5,000 is not available, it is fully taxable. Now what we need to note here is that we are talking about these benefits which are provided by the employer to the employee and therefore they are being charged under the head salaries. Now in the case of gifts which are not provided by the employer but by some other person, the head salary is not relevant. These are taxable or the treatment is done under the head IFOS under section 56(2)(x), which we will deal when we do the video on IFOS. Now as far as credit card expenses are concerned, these are also perquisite and valuation is as per rule 3. And the credit card expenses may be borne by the employer for not only the employee but also for any member of the household. Perquisite arises and we need to determine the taxable value. What is the taxable value? Taxable value is the amount of expenses which is incurred by the employee. Amount of expenses, so employee is incurring expenses and that is charged to a credit card. That is charged to a credit card provided by the employee, provided by the employer or otherwise. So the employer may provide the credit card or he may not provide the credit card, it doesn't matter, but there are expenses which are incurred by the employee which are charged to a credit card and these expenses are paid by the employer or these are reimbursed by the employer. That is the amount which we need to pick and of course we need to deduct the amount paid or recovered from the employee and that gives us the amount of taxable value, right? So the amount of expenses which are charged to the credit card which are incurred by the employee or any member of his household also. So those are the expenses which have been paid by the employer or which have been reimbursed by the employer that needs to be picked up. Now expenses not only includes the regular expenses charged to the credit card but also it includes membership fees and annual fees as well. This is also included in the taxable value of perquisite. Similarly, credit card not only includes the primary credit card but also the add-on card, right? Now there may be a situation where expenses are incurred wholly for official purposes and the employee may want to say that look, there is no benefit which is provided and therefore nothing should be taxable. So in such case perquisite is not taxable. In such case perquisite is not taxable provided the documentation conditions are fulfilled. And these are basically similar to what we saw while discussing the perquisite on account of use of motor car. And what were those conditions? That full details of expenditure are maintained by the employer, and the employer gives a certificate to the employee to the effect that such expenditure was incurred wholly for official purposes. If that be the case, then perquisite is exempt, it is not taxable. Now we come to club expenses, and this is also a perquisite valued as per rule 3. And this is broadly similar to the credit card expenses that we just now discussed. So the employer bears the club expenses which are incurred by the employee. Not only the employee but also any member of his household, and that is also taxable as a perquisite. Employee or any member of his household, the employer is bearing the club expenses. And what is the taxable value? So the expenditure is incurred in a club by the employee or a member of his household, and such expenses are then paid by the employer or reimbursed by the employer. That is the taxable value, and we reduce the amount paid or recovered from the employee. Now when we talk about the expenditure on club, then it not only includes the regular club expenses but also the annual or periodical fees. It includes this as well, so this is also included in the taxable value. Now many a times there are situations where the employer obtains a corporate membership of the club, not individual membership but a corporate membership of the club, and then the facility is enjoyed by the employee or any member of his household. In such case, while the taxable value will be similar to what we just now discussed, but it will not include the initial fees which the employer paid for acquiring such corporate membership, right? There may be a situation where there are facilities like health clubs, sports and similar facilities which are provided uniformly to all the employees by the employer, not to a particular employee, but uniformly to all the employees by the employer. In that case, taxable value doesn't arise and perquisite is not taxable. This is what we need to know. Finally, the expenses may be incurred wholly for official purposes, and the treatment is the same as that for the credit card expenses, that if those documentation conditions which we just now discussed are fulfilled, then perquisite is not taxable, it is exempt. So the employer needs to maintain full details and needs to give a certificate to the employee that the expenditure was incurred wholly for official purposes. Now there is this concept of obligation of employee being met by the employer, and this is a perquisite as per section 17.2 IV 17.2.4. What it says is that any sum paid by the employer in respect of any obligation which, but for such payment, would have been payable by whom? By the employee. It is taxable as perquisite. That means the obligation to pay is that of the employee, but the employer makes the payment. Then sum paid is taxable as perquisite, right? Sum paid is taxable as perquisite. So it is the obligation of employee, but employee is not making the payment. Instead, the employer makes the payment. So that is the benefit which is coming to the employee, and it is then taxable as a perquisite. For example, the employee is supposed to pay income tax. Employee is supposed to pay income tax on his or her income, and that is the obligation of the employee. But if, say, the employer comes and says that, no, please, you don't pay income tax, I will pay your income tax, in that case, it is the obligation of the employee which is met by the employer, not by the employee, and therefore the tax which is paid by the employer will be treated as perquisite, and it will also be added to the salary income. However, what we need to note is that there is an exemption provided under section 1010cc. Under section 1010cc, in respect of the example for income tax that we discussed, if the employer pays tax on non-monetary perquisites, on behalf of the employee, then that is exempt under section 1010cc. It is not taxable, right? So if the employer is paying income tax on behalf of the employee, it is taxable as perquisite, but there is one exemption, but only in respect of tax paid in respect of non-monetary perquisites. So perquisites can be either monetary perquisite, for example, club expenses, credit card expenses, which are paid in monetary terms, or they may be non-monetary in nature, for example, use of motor car, provision of residential accommodation, etc. So tax which is computed on account of those non-monetary perquisites is basically the obligation of the employee. But if the employer agrees to bear such tax, then without such exemption, such tax would become a perquisite and it will be taxable under section 17(2)(4). But it is specifically exempt under section 1010cc. Now, as far as all other allowances and perquisites are concerned, which we have not discussed so far in this video, they are fully taxable. That means whatever exemptions are provided, we have discussed in this video. So whatever we have not discussed is fully taxable. It is not exempt. Now, there is a concept of specified employee and it is provided under section 17(2)(3)(i) or 17(2)(3). And this says that there are certain perquisites. There are certain specified perquisites. These are taxable only in the hands of a specified employee. And therefore, such perquisites are not taxable in the hands of a non-specified employee. Right? And what are these specified perquisites? Motor car, gas, electricity, water, leave travel concession, transport facility by a transporter employer, domestic servants, education facility and medical facility. And we have discussed all of these above. These are the perquisites which are taxable only if the employee is a specified employee. If the employee is not a specified employee, these perquisites are not taxable under the head salaries. Now the question comes as to who is a specified employee. So a specified employee is a person who falls under any of these categories. Number one, he is an employee of a company and he is a director thereof. So the person is the employee of a company and is a director thereof, director of such company. So he becomes a specified employee. Second, he is the employee of a company and he has a substantial interest in that company. So he has a substantial interest in the employer company, which means 20% or more of equity shares are being held by such employee. So as per one, he is the director of his employer company. In number two, he is holding 20% or more equity shares in the employer company. And number three is his income under the head salaries, not the total income. Income under the head salaries is more than rupees 50,000 for the year. And while computing this income under the head salaries, we need to exclude. So this is exclusive of what? Exclusive of value of all benefits or perquisites not provided by way of monetary payment. So it excludes the value of non-monetary benefits or perquisites. Non-monetary benefits or amenities. It excludes the value of all non-monetary benefits or amenities. Excluding this, we compute the income under the head salaries. If it is greater than 50,000, the employee becomes a specified employee. And therefore, following perquisites become taxable only in the hands of such specified employee. Now, this concept of a specified employee doesn't have much practical utility in these times because all the tax-paying employees can be classified practically as a specified employee, right? Because this condition number 3 will be met by almost everyone, that income under the head salaries will be greater than 50,000 even if it is excluding the value of non-monetary benefits or amenities. Therefore, hardly anyone becomes an employee who is a non-specified employee, and therefore this concept of a specified employee doesn't attain much relevance, and you will therefore hardly find a question in the exam on this particular point. So this is a concept which was relevant when it was introduced in the law long time back, but for the sake of completeness, since it's in the law, we are discussing this. Now we will look at the deductions provided under section 16. As we discussed at the beginning of this video, while looking at the master chart for computation of income under this head, we saw that first we need to aggregate taxable salary payments, taxable allowances and taxable perquisites. That gives us the gross salary income. From the gross salary income, we then provide deductions allowed under section 16, right? First is the standard deduction under section 16IA, which is lower of rupees 50,000 or the amount of salary. Rupees 50,000 or the amount of salary. Second is deduction on account of entertainment allowance, which is provided under section 16(2)(i). So if the allowance is in the nature of an entertainment allowance, which is specifically granted by the employer to the SSE, then what we do first, since it is an allowance and it is taxable in the first place, it is first included in the salary as an allowance. So it forms part of the gross salary income, and thereafter we provide deduction under section 16(2)(i) as follows. If the employee is a government employee, then deduction is what? Lower of A, B or C. A is 20% of basic salary, only the basic salary, not the gross salary income. Lower of 20% of basic salary, or maximum deduction, which is rupees 5,000, or the entertainment allowance which is received. So lower of A, B or C is the deduction that we provide. This entertainment allowance deduction is not provided to a non-government employee. So no deduction is provided if the employee is not a government employee. What we need to note is that this deduction is not linked to the amount of entertainment allowance that is actually spent. So expenditure on entertainment is not relevant. Deduction is provided as per this formula. Third deduction is on account of payment of professional tax under section 16(3)(i). And professional tax is what? It's basically a tax on employment, and it gains its powers under Article 276(2) of the Constitution. So many states have this, and they charge a tax on employment. Either the tax could be paid by the employee or it could be paid by the employer on behalf of the employee. If professional tax is paid by the employee, deduction is allowed of such tax which is paid by the employee, okay, under section 16(3)(i). However, if the tax is paid by the employer on behalf of the employee, we have noted some time back obligation of the employee. If that is made by the employer, it is a taxable perquisite. So what we do, it is first included in salary as a perquisite. Tax, if it is paid by the employer on behalf of the employee, it is first included as a taxable perquisite. So therefore, it forms part of the gross salary income, and thereafter deduction is allowed under section 16(3)(i) on account of such tax paid. Now what we need to note is the word paid in both the cases. So what this means is that deduction is available in the year in which such tax is paid. So it is allowed on payment basis, it is not allowed on due basis. Even if professional tax is due, but it has not been paid during the previous year, deduction under section 16(3)(i) is not allowed. It is allowed on payment basis. For your reference, here is a summary of the connotation of salary for various computations. So this is for your reference, and I hope this will be useful. So salary means basic salary alone. When we are computing the deduction for entertainment allowance, which we just now discussed under section 16(2)(i). Salary means basic plus DA, Dearness allowance of all types, whether or not it is part of the salary for computing retirement benefits, it is included. So basic plus DA is the amount of salary which is considered while computing gratuity exemption in the case of POGA employees. Employees covered under Payment of Gratuity Act. Salary means basic plus DA if it is forming part of pay for the purpose of computing retirement benefits, that means DAT, plus commission if it is based on fixed percentage of turnover. So basic plus DAT plus CTO is the salary when we are talking about computation of gratuity exemption for a non-POGA employee. Leave salary, employee's contribution to recognized Provident Fund, VRS compensation, and house rent allowance. And when we talk about valuation of perquisite in respect of residential accommodation, what is the connotation of salary? So this is the mnemonic which we used for seeing what are the elements that will be included in the salary and what are the elements that will be excluded while computing salary. So BBA, CDM are the elements that are included, and PPR the elements which are excluded in computing salary. We now finally come to the last point of this video, which is the concept of relief of tax under section 89. And this is section 89 read with rule 21A. So there may be situations where the employee receives certain amounts which are, say, in the nature of arrears or advance or gratuity or compensation on termination, commuted pension, etc. And generally these amounts are big amounts in nature, right? Because of which the SSE may become taxable at a rate of tax which is higher than that at which he would otherwise have been taxable. So because of inclusion of these additional amounts, his slab rate of tax may go up. So as we know, the slab rates of tax for an individual are 5%, 20%, 30% in the case of a normal individual case. So if, say for example, the individual is otherwise taxable at the rate of 20%, his slab is 20%. But since these additional incomes are received, due to the inclusion of such additional incomes, he may then move from 20% to say 30% slab because of increase in the amount of total income, and therefore he may be charged a higher rate of tax. He may be charged a higher tax. On account of that, a relief of tax is provided under section 89. A relief of tax is provided under section 89. And there are different provisions for computation for different kinds of incomes, but we are discussing the provisions for calculation in respect of receipt of arrears or advance of salary. The other cases may not be relevant for exam purposes, so we are not discussing that. So how do we compute the relief under section 89? We make calculations for the current previous year in which the additional incomes are received and the original previous year to which the additional income relates. So when we do the calculations for current previous year, we first calculate the tax on total income including the additional income, and then the tax on total income excluding the additional income, and we find out the difference between the two. That gives us X. So what is X basically? X is basically the additional tax that the employee is supposed to pay on account of inclusion of such additional income in the current previous year, right? The similar calculation is what we do in the original previous year to which such advance or arrears relates to. So we compute tax on total income including such additional income and excluding such additional income, and then we figure out the difference, and that is Y. So what is Y? Y is basically the additional amount of tax which the employee is supposed to pay on account of inclusion of the additional income, right? So both X and Y are additional amount of tax attributable to the inclusion of this additional income. But X is on the basis of rates of tax applicable for current previous year, and Y of course is the additional tax computed based on the rates of tax applicable for the original previous year, and we need to see whether X is more than Y. That means merely because the additional income is not received in the original year but received in the current year, is the employee paying a higher amount of tax, right? If he is paying the higher amount of tax, then we figure out the difference, and that is something that we call as a relief under section 89, that is reduced. So the employee is not supposed to pay this difference. So basically we limit the additional tax liability of the employee to the tax liability that would have arisen for the original year, if the liability for the current year is more than that for the original year. So that becomes the amount of relief under section 89, and this is the relief from tax. Now what we need to note is the stage when this relief under section 89 is given. So it is given after we have allowed rebate under section 87A, we have charged surcharge and HEC at the rate of 4%. So after we have computed the tax liability after rebate, surcharge and cess, then towards the end we allow rebate under section 89. So minus rebate of tax under section 89, and that gives us the balance, which then is the tax liability, which is either payable or refundable. So if X is not more than Y, there is no relief under section 89. If X is less than Y, then there is no relief. It's but logical. And the last point to note is, when we are computing the tax, amounts for the current previous year and the original previous year, then we need to apply the rates of tax for those respective previous year. The rates of tax for the current previous year for this calculation, and the rate of tax applicable for the original previous year for these calculations. So this is how we compute relief under section 89, and this brings us to the end of this video. And the discussion on how to compute income under the head salaries. Hope all these provisions are now very, very clear to you. If you have any doubt, don't hesitate to reach out to me. Write your comments in the comment box and let me know if you have any difficulty or if you have any doubts or if you need any clarification. All the very best to you. Very good day.